So, guys, a very warm welcome again, and thanks for chipping in on Sunday evening. And the session is going to be very interesting. That will surely provide you with nuggets of wisdom and thought-provoking things on which you can surely work upon so as to emerge as a better investor. All the things discussed in session are purely educational, by no means any buy, sell, or hold recommendation. These are individual views and that can change at any point in time. But again, the intent and content of the discussion is to educate you guys and to make you people more informed investors. So this is our third session with Kedar B sir, and the previous two sessions are available on my YouTube channel. So if you are yet to go through those very valuable sessions, I would encourage you all to go through them, and surely this session is going to be great value addition as well. So Kedar sir is a SEBI registered investment advisor. He is founder at Congruence Advisors, and previously also he had worked in various roles. To name a few, he was ex fund manager as at Composite Investment Private Limited. He was an investment specialist at ICCI Bank, and there were many more roles which he had worked in different capacities. By education, sir is a engineering graduate in IT, and he did his MBA in marketing, strategy, and finance. And those who are active at Value Picker must know that he has actively contributed on that forum as well. And he's a fitness and travel enthusiast. So a very warm welcome once again.
Thanks, Ranpin. So thank you to the organizing team for having me on board again. So just to quickly recap, I think this is the third talk I'm doing on this platform. So if I recollect this right, I think the first talk was more on how do you use the operating experience you have to try and become a better investor. So that was the first talk. The second talk we had done towards the middle of this year was more in terms of understanding stock cycles and sort of building a framework and getting actionable items out of that. So the theme for today is obviously something that is assuming a lot of importance in I would say in today's market, where the market cycles are essentially getting shorter and shorter, and what tends to work very well today obviously cannot be banked upon to work in the medium term, even if it is something that is proven to work in the long term. So at Congruence, our focus has been this. I mean, there's a lot of, I would say, theory, there's a lot of, I would say, investment books that are written, which obviously sort of help us get to a very, very good starting point. But then our personal experience has been this. You start off as a young investor, you tend to, let's say, generally start investing when the market is already doing well. So initial few years, whatever you do, the market tends to reward you. Then one fine day, something changes in the mix. And then suddenly you sort of feel this on a daily basis saying, fine, I'm going to stick to my long-term investment philosophy. But then the market just doesn't.
So you there? I'm not able to hear properly. Is it with me only or with the audience as well? Can anybody from the audience confirm via comments or maybe through smiley? You there, sir?
I'm there, Prince. I'm just waiting for some feedback to come in terms of whether people are able to hear me.
Okay. Right now we can hear you. I think it should be fine.
It should be fine. Okay, so I'll just pick up from where I had kind of left off. At any point of time, so if there is some sort of a connection issue, or if you think there's an echo, just feel free to sort of step in and maybe just take a checkpoint over there itself.
Right, sir. Sure.
Okay, sure. So just picking up from where I was saying, so sometimes it becomes a very frustrating sort of for young investors and for investors who are not investing on a full-time basis. So one of the things that we have definitely sort of prioritized over the past, I would say 3-4 years. I mean, ever since the day Congruence Advisors as a equity advisory service was incepted, our idea has always been to ensure that we are on the right track, even from the medium term point of view, because generally what we have seen is that the long term we see it as a series of medium terms. So underperformance tends to sort of bring in a whole lot of emotional costs as well. And greater the emotional pressure that investors come under, the chances of making, I would say, long-term errors actually goes up significantly. That's been our personal experience. So we always try to, fill in that middle layer where you have, let's say, the theory and the investment philosophy sitting as the topmost part of the layer. At the bottommost part of the layer, you have these specific actions and the way you actually start tweaking or making changes to the portfolio. So the middle layer is where we are trying to connect, saying how do you work within the overall framework of the investment philosophy and whatever theory you have read and whatever is your preferred way of doing it. What is it that is going?
So lost you again. Not sure what's the issue. So if I'm audible to you, can you try dropping once and joining again? Maybe that can resolve the issue. विपिन जी आप सुन पा रहे हैं सर को?
Yeah, is this audible right now?
Yes, it is audible.
Now it is audible.
Sir, you
Now it is
can do
audible.
audible now.
Yeah, you can do one thing. Drop once, and I'll add you as a speaker again. That might solve the issue, maybe.
No, in a sense, what I did was I just went off Wi-Fi and came onto the usual data plan. I'm guessing maybe that's what was probably causing the issue. So my suggestion is let me just continue here. So if there is another issue, maybe we'll try doing what you're suggesting. Yeah.
Please. We lost for last 20 seconds, so you can continue from there.
Okay, sure. So what we are trying to do at Congruence Advisors is we are trying to fill in this gap in the middle layer. So what we see is the top layer is mostly in terms of the decisions you take, in terms of what sort of investment philosophy do you really want to sort of follow, what is your basic investing style. And on the bottommost layer, you have the specific actions that you want to take in the portfolio on an ongoing basis. So the middle layer is where this entire theme of today's talk comes in. What is that framework which is going to allow you to sort of calibrate so that you stay within the overall, I would say, the boundaries that are set by your investment philosophy. But how do you, adjust to the market conditions from time to time? So that is where we are coming from in terms of, let's say, the topic that we have chosen today. So in terms of the flow for this, so this is a shout out to the organizing team. So what we'll probably try and do is this. I'll quickly give, let's say, a 5 to 10 minute context in terms of why we believe calibration is actually extremely important. Once we do that, we want to move on to, let's say, the series of steps that investors can take, which can enable them to sort of do this calibration on an ongoing basis. Does that make sense, organizing team?
Yes, it does, sir.
Okay, sure. So let me just quickly share the broad context. I mean, there's nothing.
I don't know what's happened to Twitter these days. I mean, even if I try to join somebody else's spaces, then it causes.
Prince is it's been dealing with a glitch for the last 3 days. They're trying to sort it out. And the best is you bring him down and then bring him up. I think you'll be able to.
Yeah, that's what I suggested. What I suggested. But he may try dropping once.
Sure, let me try and do that team. So I'll just drop out and I'll sign back in. Okay.
Yes, sir. And sorry for the inconvenience to our audience. But again, the discussion is going to be very interesting and lovely. So stay tuned. Please feel free to share the link within your circle so that you guys can benefit us perspective. And it's like different from what you hear from other industry experts. I think much better and loud and clear, sir. You can continue.
Okay, sure. So I'll just maybe just quickly set the context for the next 5 to 10 minutes, and hopefully the connection will hold up far better this time. So what we have, I guess, just go back to the experience that investors have had, let's say, starting from 2020. So, or let's say if you want to take it from 2018 to, let's say, 2021. So 2018 had like a whole bunch of events that happened in the market in the aftermath of the small cap bull run that we saw in 2017. So obviously what worked in 2017 stopped working in 2018. 2018, I guess the market texture completely changed after the consumption started slowing down across the country. So you had the NBFC peak happening sometime during the middle of the year. then the entire NBFC and the private lender, I mean the entire lending team started to sort of unravel. So what worked between, let's say, 2018 to 2021 was a completely different set of themes. I mean, it is market started concentrating only on a limited set of businesses. So these were the best known and some of the most widely discovered businesses in India. But then what you see is once the theme sort of peaked out in 2020 and 2021. Now, when we use terms like a theme peaked out, we can only say it with the benefit of hindsight. And one of the things that the market is absolutely brutal on you as an investor is if you're not forward looking enough, there's no point in being a historian and saying, okay, last year this is something that I should have done. You should have a forward looking view. That is where the calibration aspect actually comes in. And if you study the market in terms of what has been really working well in the past, let's say 12 to 18 months, it's a completely different set of names. So if you'd stuck to the previous approach, I think.
Not sure what's.
We again lost him. Yeah.
Let me take a second. Am I back on?
Yeah, got it.
Okay,
Yes.
okay, sure. So strategies tend to go from hero to villain every once in a while. So it tends to happen. There are cycles there. I mean, it's not just the Indian market. Just look at what's happened in the US market once the tech rally actually started to unravel towards the end of 2021. So what we have also seen is that the investing gyan that tends to get quoted across the formal media and the social media as well, that also tends to follow certain cycles. So investing gyan narratives, they become popular, they become unpopular in certain cycles. So the stage analysis that we had spoken about in the in the previous talk that we've had, so stage analysis is something that can actually apply to investing styles and investing narratives as well, because everything is cyclical. And as is usually the case, the most dangerous thing that you can do as a medium term, I would say long only investor, is if you lash onto an idea that is already in stage 3. That is when the biggest damage actually happens to the portfolio, because in stage 3 the fundamentals still look decent enough. You will probably get slapped with a time correction, then you're followed by a price correction. And one of the things that turns out to be a huge mistake with the benefit of hindsight is when you start deploying incremental money into pockets of the market where the risk reward is not in your favor purely because of the valuations actually moving up. So this tends to be a killer blow for a whole bunch of fund managers who are the stars of a particular cycle. Now, what we are saying is this doesn't mean that you should actually go and start changing your core investment philosophy, because if your investment philosophy or the way you go about doing investing is already there in place, it is usually understood that this is something that you have tried out and this is what you are most comfortable with, both logically and emotionally.
So Kedar, we shall start so that and even if like few minutes are left by any of our audience, then surely they can listen to the conversation again on recording.
Yeah, understand, Prince. So would you like me to sort of get started?
Yes, you can start from where you left. I mean,
okay, sure. So effectively the analogy where we stopped on was, in spite of having, let's say, just look at a parallel with a game like a cricket. You can have the best team, you can have a team that's working really well, but at the end of the day, your ability to sort of read the pitch and to make those tweaks real time as and when the game is actually progressing, that becomes a very, very important component, and investing is no different. The other point we really want to stress on is that attribution analysis of, let's say, any portfolio that has either done well or not done well, I don't think it's yet given the due that it actually deserves in the Indian market. Because what happens is, if you do a detailed analysis of, let's say, any portfolio out there of a mutual fund, I would say not so much as a mutual fund, but let's talk of, let's say, portfolios like a PMS or a small case, where you end up holding anything between 20 and 30 stocks, you'll probably realize that every fund manager or every scheme out there is overweight certain factors and underweight certain factors. So factors, when we say, we mean things like, let's say, value, momentum, growth, business quality, whatever you want to call it. So there are certain factors out there which tend to dominate certain portfolios. Now, at different points of time, the market tends to reward different factors disproportionately. So what happens is there will be a certain periods of time where the market just goes overweight completely on the. Hello. Yes.
Yeah.
Okay.
Yeah, you were telling about the period of like overperformance, overweight.
Yeah. So just checking if the line was clear enough. So looks decent. So I'll just proceed with the entire flow. So what we were saying was this entire attribution of the market and the overweighting and the underweighting that it tends to give to various factors. Now we're not just talking, let's say, sectors. We're not just talking themes. So there are certain factors that are always at play in the market. So this tends to create a whole amount of cyclicality in the alpha generation game. So the ultimate outcome of this entire thing is what we have observed is this: those who tend to have a static approach, so they will usually have to mentally reconcile to periods of, I would say, underperformance even over the medium term. So if you can have a strategy that works really well over 10 years, but then the same strategy may look really, really silly over a 3-year, 4-year time frame in terms of the intermittent period. So that's one very important point. The other thing that you've seen is earnings expansion. Obviously, it's probably the most important factor that tends to drive stock performance over the long term, but it is not everything. You can have situations where the earnings is growing at 15%, 20%, but the PE multiple just falls from, let's say, a PE of 70 to a PE multiple of 50. There itself, 2 years of return you sort of given away, and that is where the underperformance actually starts to reflect. So personal experience, once again, if we go back to the market pivot in 2021 and 2022, this cemented many of these learnings which already were there, which we couldn't really execute on to the best of our satisfaction then. So what ended up happening was, as the market went into this 2021 and 2022 pivot, if you were overweight certain sectors like, let's say, chemicals, financialization, and a whole bunch of other things. Okay, sure. So just feel free to maybe just come in whenever you see there's a little bit of this thing. So my sense is maybe if we just wait for 5 seconds, the line seems to be getting slightly clearer again.
Yes. And the very moment we get any glitch, I'll let you know. Sure.
Yeah, please. Okay, so let's do that. So what we have seen is in 2022, you had to pivot into certain other pockets of the market, which ultimately, if you come down to the nuts and bolts of it, it's yet another factor that the market had started to overweight starting from 2022. So what we are saying is just getting your assessment of business quality and earnings trajectory right is not really a fail safe if you're somebody who's focused on performing well in the medium term, because a PE multiple derating can always hit you, even if, let's say, all other factors sort of either remain same or some of them change. Now, coming to the final point, which we just want to cover as part of this context setting, is now large fund portfolios tend to have an impact cost, whereas retail and I would say even HNI portfolios don't really suffer from this sort of a, I would say, let me call it a constraint. So in that sense, I guess the supreme thing that we always need to keep in mind is the market always has a mind of its own. This always needs to be the starting point for most investors. Investing is a social science. What we really need for performance to fall into place is either we need to come around to the market view, or we need the market to eventually come around to our view. So one of these two things needs to happen for us to win at the alpha generation game. So the market tends to give enough opportunities to exit and enter. It is, even if you take a secular sort of a bull run in a particular stock, 3 years, 4 years, there are always decent entry.
That we lost you for the last 10-15 seconds.
Sure. Is this fine? Is this okay now?
Yes. You were telling about the market has its own mind and maybe.
Yeah, sure. So let me just pick it up from there. So the market tends to have its own mind. Investing is a social science. So either we need to come around to the market view, or the market will have to eventually come around to our view. So that is when alpha generation can actually happen. So the market tends to give enough opportunities to enter and exit to investors who don't really suffer from the sort of, I would say, constraints which plague a lot of large fund portfolios. So the bottom line for good medium-term performance seems to be this: we need to have exposure to pockets of the market where the earnings trajectory is expected to be far better. It's expected to actually improve. That's the first condition. The second condition, obviously, from a fundamental point of view, is that the valuation has to be reasonable. And the third point is the market reaction to these expected earnings materializing has to be disproportionate. That is when alpha generation happens. So these 3 points become very, very sacrosanct, whichever way you decide to sort of, go about doing this entire exercise. So if this calibration happens consistently enough, it's very rare that you will see massive underperformance in the portfolio. You will probably take 2 months, 3 months to sort of, make the necessary tweaks and to sort of align the portfolio to the current factors that the market seems to be more interested in. So the bottom line or the entire takeaway from this context setting exercise is this: every investor needs to have a framework that allows him or her to first and foremost sense what exactly is changing in the market that allows them to sort of understand what exactly is changing in terms of the texture of the market. Number one. Second thing is, now that you have recognized what exactly is changing in the market, how do you go about calibrating to the entire thing?
Kedar, we lost you at the point where you were telling about how we can calibrate to the market. Kedar, am I audible to you? Thanks, Ravi, for confirming. Not sure what's happening today. Even we restarted.
Do you know if he's joining from a computer or is like mobile
I
phone?
hope it is from mobile only.
I am
Kedar, are
through a
you?
mobile. I am there. So I was joined in through the mobile phone.
Okay. No, it's fine now.
Got it,
So
because
you were telling about
yeah, it's fine.
you left at the point how we can calibrate with this. Yeah.
Yeah, exactly. So I guess this kind of, wraps up the entire context setting exercise. So the questions to ask ourselves is, do we have a framework that allows us to sense what exactly is changing in the market? Number one. Number two, how do we translate that learning once we have sensed it into a series of actions that allows us to make the tweaks to the portfolio? So, and the point number three is, can we do this on a consistent and a sustainable basis? So those are the 3 points that every investor needs to sort of evaluate on a very, very timely manner. So with this, we just go into the next section of the talk. So we'll just run you through a series of steps, or would say the things that we do on an ongoing basis, which we believe kind of keeps us on track in terms of this calibration aspect, right? So from here, so this is to the organizing team. What I'll probably do is maybe I'll complete like a couple of points and then we'll sort of, throw the line open for a bit of interaction as well. Does that work for you guys?
That totally works, Kedar. Yeah.
Okay, sure. So we'll just maybe do 2 points at a time so that we ensure that this thing is very, very structured. So the first thing, once again, this sounds very, very cliched, but it's very, very important. We need to reinforce certain basics every now and then till they are so ingrained in our psyche and ingrained in terms of our decision making process as well. Now, what are those basics? The first basic point is this. Hello?
Yes. So you were telling about the first point. Yeah.
Yeah, so the first point is we need to reinforce certain basics every now and then. So the first point to sort of always keep in mind is this: the market is a forward looking relative attractiveness voting machine. So the keywords are two. Number one, forward looking. Investing is not about the past. It's not about what a business has done over the past 10 years or what it has done over the past 5 years. Number two is relative attractiveness. Now, this relative attractiveness is a very, very important concept. So, at times when the market doesn't see visibility of earnings growth in the broader market, the market tends to become very, very narrow. It tends to load up on certain businesses where you have certainty of earnings visibility, and those businesses get bid up to the moon. That is what was happening for some amount of time in the Indian market. But once the market starts to sense saying you will get healthy earnings growth in a broad-based manner, what tends to happen is the market run tends to get much, much, much broader. So this is one very important point to understand. You need to ask yourself, is this a narrow market or is this a broad market? Second point, concepts, all of this that we talk about on all of these calls, it looks very, very simple in hindsight, but execution in the real time is going to be full of uncertainty. So that is something that we really need to reconcile to. There is no perfect strategy. It is something that you'll have to sort of come to in an iterative manner. You're going to make mistakes along the way. Third point in terms of the basics is we either need to have an analytical edge or a behavioral edge to succeed in the market. One of these two is extremely important. When we say analytical edge, it means can you pick up a story and say we
And it's down, not sure. So Ravi, can we do it? I mean, maybe the issue is on my end. I drop and we start the spaces from your handle if that works for you.
Yeah, it works for me, but I know that there have been glitches. We can try that if you want.
So what do you suggest,
uh,
Kedar? Shall we do that, or I mean, it's we are still experiencing
no,
intermittent.
I guess if it's an issue that's been happening across people for the past 2-3 days, my sense is it's probably not localized. So we might have to make do with whatever conditions we have right now.
I agree. Let's do it the way the market is. So let's just
Uh,
we
that's
actually
that's
we need to, yeah, we need to calibrate here as well, right.
yes, yes.
That would be a wise decision. Yeah, Kedar, you can continue. Sorry for the interruption.
uh, so so that's a pretty good way of putting it. So just picking up from what I was saying. So analytical edge is where you can say I can get the earnings trajectory right better than most other people in the market and actually bet your money over there. Or you need to have a behavioral edge which says ITC at a dividend yield of 5.5% and at a PE of 13.5. It's too good to last. I will hold it for the next 5 years. I will outlast everybody else in this stock. Eventually, I will wait for the stock to actually price itself at the appropriate level. So either an analytical edge or a behavioral edge. I'm not aware of any third possibility that you can do on a legal and in a moralistic sense. So these are the only two possibilities. The final basics that we need to really harp on is this: depth and breadth of analysis are equally important. As we said, the markets can be narrow. When the markets are narrow, the entire investing gyan or the entire narrative centers around understanding, let's say 25, 30 businesses so well that you have the conviction to hold them through for the next 10 years, 15 years, 20 years. But when the market becomes broad, what you really need is how much.
Lost again.
Okay, is this audible?
Yeah. Now only
Okay,
5 seconds
sure.
lost. Yeah. So
I
you were
understand.
telling
So
about the sphere, like mastering 35 companies and staying for long, and then the market get a broader market.
exactly. So when you have a broad market, what's important is how many themes can you quickly cover, how many stocks can you understand at an acceptable level of depth. So the big takeaway is this: we don't have to obsess over 30 businesses all the time. At the same time, we don't have to be tracking 150 or 200 businesses all the time. Based on the flavor of the market, you need to understand what is it that I really need to focus on. Depth and breadth are equally important. Personal experience has been that depth is given a lot more importance than breadth. I mean, a simple anecdote about depth. If, let's say, somebody is able to pick up a stock like, let's say, an HUL, even if you spend 1,000 hours researching that business, can you come up with any differentiated insights which the large institutional counters do not have? Unlikely, right? So in that case, what's the point in really harping on depth of analysis beyond a level? Instead, you take 100 hours of that, you spread it across 10 new businesses. Chances are you will discover something which is currently undervalued, where probably the risk reward is pretty much in your favor. So to wrap up, the first point I think we need to remember is keep reinforcing all of these basics every now and then till they get really ingrained. So now moving on to the second point, which is a sort of an outcome of this first point itself. Investors need to minimize blind spots, and trust me, every investor has blind spots. You pick somebody who focuses on market depth, chances are his coverage will not even exist on, let's say, the rest of the market. Or you pick somebody who has a very good level of, let's say, breadth, then what happens is or anything like that.
Yes, you are back again.
Okay, so I was just saying I don't feel the signal coming or going back at all. To me, it's fairly consistent from my side.
अच्छा यार क्या क्या दिक्कत हो रहा है? I mean the talks are so interesting और बीच में जो कट आ जाता है ना, मजा सा थोड़ा खराब. Anyways, I mean you were summarizing these 2 points, and you were talking about minimizing the blind spots, right?
Yeah,
So we
exactly,
can.
exactly. So let me take it from there. So minimizing blind spots, it calls for a lot of hard work over 2 to 3 years for a retail investor, because you will most likely have a day job that you need to do. You will be allocating a fair amount of time over the weekend. So I think 2 to 3 years is like a realistic estimate for anybody who wants to increase the coverage. So what we would definitely suggest, and this is something that has made a big difference to us. So tracking results in a very, very structured manner every quarter, and eventually rolling it up to a sector view, starting with a bottom up analysis of the businesses in each of the sector. That's made a tremendous change to the way we actually think about the markets. Now what this ends up doing is this: you may choose not to invest in, let's say, the nifty 50 companies, but it doesn't mean you can afford to ignore the market leaders, because the market leaders are the ones who call out trends much earlier than all of the other players in the market. So what generally ends up happening is the depth of understanding is, once again, it's a bit overrated. Breadth of coverage is very, very underrated when it comes to the retail investor perspective. So we would say, once again, to reiterate, first point is to reinforce all of these basics that we spoke about. Second point is to have a broad enough coverage, minimize blind spots, and do the hard work that it really takes to track results, to track themes in a structured manner, and to sort of summarize your learnings and to ask yourself where exactly we are sitting.
Lost again, bye.
It's like a teaser, right? The minute something big is going to come out, it goes into a pause.
I think there is something from
No,
X or
every
Twitter.
space, just to let you know that all the
So
spaces here, also in the US.
as and when we have a great subject and different perspective, these guys do something so as to interrupt that.
Interesting, guys, interesting. So yeah, so I guess those were the 2 points I wanted to sort of cover upfront. So good idea to take a few questions from here before we move on to the rest of the things.
Yeah. So you were talking about the cyclicality in alpha generation, and even you talked about briefly about the attribution analysis in which the fund managers and other financial market participants at times go overweight on something, and they ignore the other aspects, and that brings the period of underperformance and overperformance. And you very rightly said that if we work on those front, and if we cover the breadth of the market and find out, I mean, cover more aspects and find out which sectors are in flavor and which pockets you can definitely find value. So definitely we can work on that. So anything more on that front, like for a retail investor, obviously it brings a lot of hard work to cover most of the market. But what would be your suggestion, like how we can easily achieve that?
Yeah, so in a sense, it's like this. So it's a question of what is it that you can do on a sustainable basis, number one. And number two, how do you keep adding to your coverage over a period of time? So one of the approaches that we really take is, as part of the ground up research process itself. Let's say we were to pick up a new stock for research. You do a thorough competitive analysis when you research the stock itself. So that what happens is, when you start tracking the stock, it is not just the stock, but you start tracking the entire value chain as well. The whole point is this needs to happen on a very structured basis. So as an example, we have something put up on our website.
Kedar, if you can hear me, you can try one thing. If you go to these three dots on the top, try to turn on the caption, turn them on and off 2, 3 times. Sometimes that helps you on your side. So if you look at next to leave, it says there are three dots, and you
Mhm.
click on that, it will have captions. So turn
Yeah.
on captions and turn off. Just do that 2, 3 times, or just keep it on when you're speaking. I think that will also help.
Okay, I've just done that.
We can hear
Okay.
you now.
You can hear me now? Okay, fine. So we have the sample that is put up on our website. I mean, that's the way we do it. So you can try and automate it. If it's somebody who has a little bit of a tech focus, try and use automation to the extent possible. For certain reasons, we try to do it manually because we are fundamental investors first, and that's the way we sort of think. But if you can pull some sort of a data model, take the feed from a screener or do something else. So just set up those alerts so that you systematically do this on a quarterly basis. So that I would say that's the first starting point. Just do it in a very, very structured and a very sustainable manner.
All right. So we got one speaker. Let's take his questions. Cool man, right? So, Mr. Coolman, you can unmute and ask your question to Kedar.
Hey, hi Kedar, and thanks for giving me this opportunity. As everyone talking about in between the disconnects are really disturbing. The something very interesting is going on, and we break that chain. So anyway, I was just keen to understand, like there are a lot of thoughts going on, like there is a global slowdown is coming, or a lot of global market people are talking about the slowdown coming, which is next year or something. Compared to that, India, I don't see any like all these market channels. I'm not seeing any discussion on that. So just wondering, how's the experts guys, or experts views on that?
Yeah, thank you for the question. So in a sense, I mean, it reflects in the Indian market as well, right? So we just need to look at it this way. What are the sectors that have an export focus? So those are struggling one way or the other. If you look at, for example, a sector like an IT services, so the outlook clearly reflects whatever you have spoken about, right? Because IT clearly is generally a discretionary spend when it comes to the new business development. If you look at pharma, if you look at, let's say, chemicals, so it already reflects. So once again, it's one factor. It's actually one of the factors that we consider. So are you overweight the domestic Indian economy, or are you overweight, let's say, the export oriented businesses? Because there are times where export oriented businesses just deliver significant alpha to you. So it's a very interesting question. So that's the first part. The second part is, obviously, I think the global situation is something that a lot of people are not used to. So
Kedar.
I don't know. Sorry to say, but I think last couple of lines I missed. Is it only for me or
No,
for
no, no.
everyone?
It's for everyone. Wait for a while and please be on mute when the speaker is speaking so that we don't
Sure,
get
sure.
any echo,
Yeah,
right? So probably
sure.
Kedar will come and start from here.
Okay. Might be, Kedar is listening on the same point. I just wanted to.
This is criminal on Twitter. I mean, the best platform which Twitter has, and they are yet to get over the glitches seriously. Ravi?
I think
yeah,
they've been, just to let you know, they've been like Russian and Chinese attacks on this platform. So, Kedak, whenever this happens, just try to turn on and off the caption. It'll bring you back. So, back to you, Kedak.
okay, understand. So I guess I'm back on, right? You guys can hear me?
Yes, yes.
Yes, yes.
Yeah, so just to answer that query once again, so I guess what I was saying was, so that's one of the factors that we need to sort of track. So there's a lot that's actually happened in the global level in terms of the macro developments. So whenever a regime sort of changes, you move from a regime of very low interest rates, you get into a very steep interest rate cycle. So the psychological effect on a lot of entrepreneurs is there were a lot of projects that were getting funded purely because capital was so cheap. So today, as an entrepreneur, I would probably just want to ensure that my whatever investments I make are going to be going into the right areas. So you don't want to take any long-term decisions in the face of such uncertainty. So I believe that is something that already reflects in the market performance of the country. So yeah, I think it's fairly synchronous that way. It tends to get priced in almost immediately.
Hey, thanks. That's very helpful, in the current market scenario. Just wondering, you mentioned, the factors which are, the companies which have export oriented has mainly the time, even the companies the domestic manufacturing companies like Bajaj or something, nowadays they are also focusing more on a export business. If I'm not wrong, if I looked at last year figures for any two-wheeler manufacturing company, the export figures are more than what they sold out in domestic market. So I am just little not worried at all, but curious to understand, does that really impact on the the current growth what we are seeing in the market, like?
Yeah, I think that's a very fair observation because this entire concept of making in India and selling to the world across segments. So it's not just in manufacturing. We are starting to see that in, let's say, wires and cables as well. Some of the capital goods that we make in India. So over there, it's not just an economic angle, but there's also a supply chain angle. Given whatever has happened in the world in the past 2 to 3 years, so I think for the longest time, the whole narrative was that globalization, the world is getting flatter and flatter. You manufacture in the country which can give you the cheapest rate. It's absolutely fine for you to sort of build up a huge deficit on that front. But then what happens is, in the past couple of years, people have started to realize that you can't really build up so much of fragility by depending on one single, let's say, country partner. So when people look to diversify their supply chains, obviously there will be some pockets where India is benefiting. So I think that's another interesting theme that we always have our eyes and ears open for. And we believe that's a theme that will only continue to pick up pace from here if the current policy environment continues to stay consistent. So thank you for bringing that out.
Hey, thanks Kedar, thanks a lot.
We got another speaker, Karthik. So I am Karthik. You can unmute and ask your question, please.
Good evening, sir. This is Karthik. So my query is to the Kedar, sir. I'm putting my investing purely based on the dollar-based investment only. So exporting based like IT sectors and the pharma sectors, purely like many sectors, companies are doing very well in the last 12 months to 14 months. So today, during high position, last 2 weeks, the market has been high. So may I continue my invest in this all ID sectors on the export related part, or what is your view about? Because many of my friends are considering nowadays their large cap returns are not that much good compared to the small. So it's so passive for all people investing their money and hard-earned money in small caps and mid caps. So I didn't find any kind of valuation in the, and many small caps are earning more and more 30 to 40% in the last 2-3 weeks. What is your view?
So if I understand you right, Karthik, so I guess this is a question that is specific to your context. So I think I can give you maybe a high level view. So if I understand you right, looks like you're overweight certain sectors that are export oriented, right? Like IT, pharma, and things like that. So look at it this way. See, there are always two decisions that you need to take when it comes to managing your existing portfolio. Number one, existing portfolio, do you want to retain? Do you want to tweak? The second part is incremental money. What do you want to do with it? So our suggestion to people is always this: incremental money should always go into the pockets where you have those three conditions. So just to reiterate, you want to be in pockets where the earnings outlook is either getting better or is expected to get better. Number one. Number two, where the valuation is reasonable. And number three, the market reaction post good earnings has to be disproportionate to some extent. So our suggestion would be, if you're stuck in themes that are not really, haven't done too much and there's a fair amount of uncertainty, incremental money, we believe it should be going into a different set of themes rather than, going into the same set of themes, because the risk of for continued underperformance is something that you can't really estimate in a very, very precise manner. So given the information that you've given, I guess this would be my broad high level answer to you, Karthik.
Thank you, sir. And one more question to me. And at the present market, which sector is the most favored for the many investors? Like in US, the AI sectors are the most people are investing a lot of money in the AI sectors. So, like in India, what are the sectors people are having a lot of interest to, like financial? Please your views.
So I guess in India, see, the interest continues to be in a whole bunch of pockets where we are significantly worse off compared to the rest of the world. Right. And coming to your question on AI, Karthik, so obviously I'm not a domain expert on AI, but we believe that themes like this are only sort of, evolving over a period of time. So for you to actually take a public market play, which is specifically focused on AI, we believe it is going to take a fair amount of time, because those opportunities generally tend to come into the private market first. It comes into the private market, and that's a better way of participating if you're a domain expert over there. By the time something comes into the public market, our experience has been it tends to come in at a pretty high valuation, unless you can play it through a theme that has an indirect exposure. But then, as I said, we're not really the domain expert on that, so we are waiting and watching for the situation to evolve on that front.
Sir, if my returns are, I'm happy with that. So can I withdraw my so what I invested money from the market, and can I invest the money in the gold? I think the gold is surging in the last.
So Karthik, here's my request to you. See, if there is a specific query that you have about your personal situation, we believe it has to be maybe a one-on-one discussion with a qualified advisor. So we'll be very happy to do that, but that is something that has to be done offline, Karthik, because we are only talking of generic concepts over here. So my suggestion is, questions that are very specific to, let's say, your context has to be handled in a slightly different manner.
Exactly. So I think, shall we take one more speaker, or you continue and then we move on to? So Ranjan,
we can take one more speaker, please.
Yeah, Mr. Ranjan, you can unmute and ask your question, and please limit your question to one, and make sure the question is context specific. Yeah, over to you. Mr. Ranjan, maybe any glitch. Anyways, Kedar, we can continue with the conversation. So as and when he will has his question, so he can surely raise his hand. Yeah, over to you.
Okay, sure. So I'll just pick off on, let's say, we covered 2 points as part of the entire calibration framework. I'll quickly cover maybe the next couple of points, and then we'll take another break for a set of questions. So the third point we want to cover is, see, we need to be always aware of the factors that have performed. How have they performed, and why have they performed over the past 24 months? So simple things is this: can you articulate what has outperformed over the past 2 years and why? Similarly, can you articulate what has underperformed and what are the reasons for that? Underperformance, is it happening on the back of an earnings slowdown? Is it happening because of, let's say, excessive leverage in the system? Or is it happening because of, let's say, cyclicality in the PE multiple that the market seems to be giving to them? So understanding these factors and tracking them is actually a very, very important component of this entire calibration exercise. At the same time, if you don't want to do this at a stock level, one of the easiest proxies to do is this, and trust me, it works really well across cycles. Just observe who are the fund managers who get the maximum airtime in all these business news channels. So just go back to 2017, 2018, when the small cap mania was at its peak. Just ask yourself, who was the fund manager who was being invited by the business channels to sort of, come and air his views on the market. Now, what you will see is these market participants, they tend to change from time to time, because the person who gets the maximum airtime is the person who has the best short-term performance at that point of time. So it's not just about focusing on the person, but try and understand what is the investment style that has gotten the maximum airtime, and more importantly, what are the narratives that these fund managers are actually trying to communicate. Because every fund manager, we believe, is very, very intellectually honest. They believe that the way they are going about things gives them the best chance of beating the market. The market can be cyclical.
Kedar, please come again.
Yes, is this fine now?
Yes.
Yeah, so I'll just pick up. So I'm saying just try and understand the style that has worked really well, and more importantly, what are the narratives that these successful and prominent fund managers are actually talking about. So just make notes on which particular style has been rewarded by the market in the recent run. That feeds into your thought process about incremental capital. Where is it that you really want to deploy? So just going back to what the question that one of the previous participants was asking. So he's saying my money is mostly in large cap. So I'm not taking him as an example. It's just a real time example that's come together on this call. So a lot of people are facing these challenges right now. I think till 2021, they had loaded up significantly on some of these large caps, very well known companies, excellent companies. They haven't done well. Right now, they are sitting on a whole bunch of, let's say, underperformance with respect to the benchmark. Right now, they observe that small caps, mid caps have done really well. So incremental capital kahan pe dalna hai? So that's a very, very important question. So once again, just go back to that framework. Do you have clarity on earnings expansion? Number one. Number two, do you think the valuations are reasonable? Right? Number three, then you'll have to sort of, go and ask yourself, ki, what is the market reaction to good earnings? Are stocks going up post good earnings? Then you know that you are still, let's say, either early or midway in the cycle. So always be aware of what exactly is happening and start articulating the entire thing. That's point number three. Point number four, we believe is extremely underrated within the retail investing community in India, which is you need to have a decent base of macro knowledge and you need to understand how liquidity impacts valuation, right? So the unfortunate thing is if you go by, let's say, classical finance, if you go by, let's say, some of the puritans out there who are proponents of value investing or fundamental investing, they will tell you that macro doesn't matter. What they actually mean is macro doesn't matter if you're investing for 10 years, 15 years, because
Sir, please come again.
Yes, so just repeating what I was saying. I'm audible, right? Please give me a confirmation. I'm audible. 2-3 seconds. Oh, okay, that's fine. That's much easier to deal with rather than the 10-15 seconds of off time. So what I was saying was, I'm saying you need to have a decent base of macro knowledge. When a fund manager or an investment guru says, I can't build an investment strategy centered around macro, what he means is I'm investing for the 10-year time frame. I'm okay with interim volatility. Ask yourself, as a retail investor or as even a professional investor, is that something that you're really willing to live with? If not, then you need to understand what's happening in fixed income for you to be able to price equity markets. Because if you go by the fundamentals of valuation, if you want to value a stock, if you want to do a DCF, what is the cost of capital? I mean, you take a 10-year view of the Indian GSEC, the rolling return is close to 8%. But what does the GSEC trade at right now? You're closer to 7.2, 7.15, whatever it is. Going forward, what do you think that number is going to be? So all this gives you some sort of a framework where you're asking yourself, if I keep everything consistent, if the cost of capital goes up 2% from here, what is going to be the impact on the terminal value? So you cannot price equity unless you understand fixed income, because interest rates impacts everything under the sun, right? And certain themes and certain business models, they are hypersensitive to a particular macro variable. Classic example, IT services, everything else remaining same. If the rupee goes from 83 to 75, what do you think is going to happen to their profitability? Or let's say if the rupee goes from 83 to 100, what is going to happen to their profitability, right? Now there are certain business models where you don't have significant cash flows. The business is still being run in an investment mode that is equivalent to a zero coupon bond in the fixed income terminology, which
Please come again, sir.
Yes. So just repeating what I was saying. So certain new age business models where the cash flow generation is not very strong, where the unit economics is not very. Am I audible?
Yes.
Okay, let me continue. So it's the equivalent of a zero coupon bond. So when interest rates rise, a bond that does not give you interim payments gets hammered to a great extent. So you need to understand concepts called basic duration. I mean, it's a counterintuitive concept, but I think investors will need to sort of invest the time and to build a decent base of macro knowledge, because then you will be able to translate what is happening in terms of RBI cutting interest rates, government doing a whole bunch of things, बजट में क्या चल रहा है, you'll be able to translate it into a view for some of the stocks and the sectors that you're actually holding. And that translation in terms of what is happening, where exactly is cash moving to in the economy, it affects valuation, it affects the business prospects as well. So my genuine request to everybody is this: please give it a sincere try. It's not easy to understand, but staying at a score of 0 or 10 out of 100 is also not really acceptable if you're a serious investor. So we would suggest work with a reverse DCF mindset. We're not saying take an investment decision purely based on a theoretical construct like a DCF. Work with a reverse DCF mindset, because then you're asking yourself, how is the balance sheet going to change? How is the P&L going to change over the next 2 to 3 years, and what are the assumptions for that? So once you do that, final point, liquidity, massive implications. Just look at the month of November, just look at the month of December, right? A gush of FPI inflows, even for 5-6 trading sessions once it comes in, following a period of muted flows, you will see what happens to the Nifty 50. You will see what happens to the Nifty 50. So we keep tweeting about this, we keep writing about this all the time. The Nifty 50 benchmark index level, it is.
So please join again.
It's exact that moment, right, when he's about to say the Nifty, and then it goes into complete silence.
Yeah, I hope this is audible.
Yes. We only
Yeah.
lost 1 or 2 seconds at the very moment you get dropped. So I pointed out. So you can continue.
Okay, sure. Oh, okay, sure. So just to reiterate, what we have seen is this: the Nifty 50 trajectory is most sensitive to a delta change in the FPI inflows. What I mean is 3 months of inflows and then 1 month of outflows, you will see the impact in the negative sense, right? It is not about the quantum of money that comes in. It says where exactly is the trend change happening. 3 months of outflows, and then let's say even 20,000 crores, 25,000 crores comes into the equity market. You will see the Nifty is moving up 4%, 5%. So tracking macro, tracking liquidity, this has a massive thing, because generally what happens is Nifty moves, then the market starts to price in some of the smaller companies, saying, okay, relative valuation wise, this guy deserves to trade higher. So I'm not saying this is predictable or this is doable. This is not, definitely it is not predictable, but it's a very important factor in the short term and in the medium term. And it is extremely important. So I guess, yeah, we covered points number 3 and 4. We have another 2 to 3 points to cover after this. So do we want to take a checkpoint here and see if there are any questions?
So one quick question, Kedar, is like you focused or emphasized that we should be having a sense on the macros, and so do you buy that statement, like after initial hard work of few years, the incremental knowledge doesn't take much of your time to be like what's happening around? Is that fair assumption?
I think it's a very important statement, and I'm happy you brought that out. So see, it's like this: when my skill set in a particular area is, let's say, at a 40% mark, the bulk of the work, once you start doing it in a structured manner, once you cross, let's say, 80%, 80% to 90% takes a hell of a lot of effort. It takes years. Then what happens is, so there is a concept in baseball that says you have to cover all your bases. So if you think your stock investing or your business analysis framework is working reasonably well, you will derive a higher amount of benefit by focusing on other things. So look at technicals, look at macro. That is going to give you a perspective which you currently do not have, and you will be able to connect the dots in a much better manner. In fact, that's one of the most enriching parts of an investor's journey. You can use philosophy, you can use economics, you can use game theory, you can use understanding of geopolitics. Everything fits into the markets, trust me. So I think that's a very important perspective to have. You need to cover your bases.
And see, it takes a long time so as to find out our blind spots. So what is there any process through which we can work for the betterment on these front, or maybe finding out things and improvising on them?
Yeah, so once again, personal experience, I think that is where the use of checklists becomes very, very important. So I remember at the start of my serious investing journey, which I would peg at, let's say, 2013, 2014. So that was the period when I actually started asking myself, this is something I want to do for a living. But then I knew that in terms of, let's say, the perspectives or in terms of the skill set, I wasn't really up there in terms of the capability. So I built myself a 70, 80 point checklist. Series of questions that you have to mandatorily ask yourself before you make an investment. Macro, do you understand how the current macro impacts this particular company? Number two, corporate governance, what exactly is a view? Number three, okay, what is your view of the particular valuation? Number four, have you really covered the entire competitive landscape? What is the extent of pricing power? So this is where an investment process actually becomes very, very handy. And trust me, you don't have to do this consistently. Do it for 5-6 companies. Imbibe 60%, 70% of the process so that it becomes second nature. And then you're fine. And then you just take it from there. So very, very strong proponent of doing structured work, very, very strong proponent of using investment checklists. So in that context, I think a book that I would suggest is there's a book called The Investment Checklist by Michael Chern. So I think that's something that every retail investor will have to read. And then you can start building your own layers on top of that. Right, that is how you come into your own process, rather than doing a bit of patchwork from taking one thing from somewhere. That is also absolutely fine, but end of the day, your framework has to stop you from making a set of mistakes that you as an individual are very, very susceptible to. Let me put it that way.
Great. So Ravi, anything on your part, or shall he continue with his next points? I think Kedar, we shall get going, and as and when we have question, we'll stop you and ask the question. And also for our audience, as and when Kedar covers few points and ask you for questions. So if you have any questions, surely feel free to send in speaker requests. Yeah, Kedar.
Okay, guys, thank you. So continuing with the flow that we have planned. So the point number 5 that we want to really sort of cover is, once again, it's a derivative of what we've spoken about so far. You need to understand base rates. You need to understand base rates so that you can put the current numbers in the right context. Otherwise, the chances that you'll get carried away with something that is happening in the market is very, very high. So simple questions. How many businesses have managed to go profits at 20% sustainably, predictably over a long period of time? It's actually a very, very minimal set of businesses, and it's a serious outlier event. So if that's the case, if your reverse DCF analysis tells you that the current stock price seems to be discounting something like a 20% earnings growth over the next 5 years, I straight away know that this is not going to be a high probability endeavor unless it's a real outlier. Okay. Other basic questions. I mean, forget slightly technical stuff. Let's talk of basics. For how long has a bull market sustained in India on an average, starting from, let's say, 2002? So 2003, 2004 up till 2010, 2008, it was a secular bull run, 4 years, 5 years. After that, India has always been a start-stop market. You have an average year, you have a good year, and then you have a bad year. And the bulk of the money tends to come in during the good years only. I mean, this is something that is well documented, that is well covered by every single advisor out there. But the behavior of investors tends to, sort of contradict some of these learnings. So even in terms of, let's say, running an equity subscription business, we tend to see it years like 2021.
We lost you.
Let me just try this again. Okay, am I back up?
Yes.
Okay, sure. Let me just continue. So ask yourself these basic questions. So what has been the longest period of outperformance by a particular sector in India? It's a very interesting answer once you do the groundwork, right? So some of these mutual funds, they print this chart, right? Over the past 10 years, which was the top performing sector in each year, which was the bottom performing sector in each year. What you will see is top, bottom tends to sort of, interchange on an annual basis. Whereas there are some sectors that tend to give you a long-term view. consumer, IT, once they do well, the party lasts for 3 years, 4 years. But then you go into a lull for another 3 years, 4 years. These are basic trends. These are basic trends. Okay. Now, if you once again come back at a stock level, just look at the historical price chart or the stock chart of a particular company and ask yourself, has this price pattern, has it been very volatile or has it been steady? Classic example, look at something like a PI Industries. It goes into a time correction, it doesn't go into a price correction. Whereas there's a whole bunch of other businesses where, they become the market darlings. But then, so in such a case, before you make an investment into that particular stock, or if you start overloading on a particular factor, if it is proven historically that the base rate of, you making money continuously for 2 years, 3 years is very, very low, why do you want to make that bet? So this is what prevents you from making mistakes on a day-to-day basis. Okay. And then one of the more interesting analysis that you can actually do is this. Ask yourself, what kind of stocks within a particular sector move in the early part of a bull run, the mid part of a bull run, and the latter part of a bull run. You can do this at the market level. You can do this at the sector level. You can probably do this in multiple ways as well. If you do this analysis, it tells you certain patterns that you need to avoid. These are the patterns that you really, really need to avoid. So understanding base rates.
Kedar, please come again.
Was once you look at this basic high level data, and trust me, once you start doing this, it's not going to take you more than a week. So just take the Nifty 50 return on a 3-year rolling basis. The moment you see a trailing annualized return of more than 16%, 17% at the Nifty 50 level, you will see the next 3-year return is not going to be very high. It will probably be closer to 7% or 10%. So these are simple patterns which will allow you to calibrate to the market. This may not change your long-term prognosis or your long-term investment philosophy, but this is how you sort of, keep making those adjustments on a quarterly basis. How much of cash do you sit on? It becomes fairly simple. It doesn't mean you will get it right, but at least you'll have a method to the overall matters. So what stocks move in the early part of a cycle? What stocks move in the mid part of a cycle? What stocks move in the latter part of a cycle? Very, very interesting analysis. So we say understand base rates, understand probability, and make it a part of your decision making framework. So moving on to the sixth point, I guess this is something that you've spoken about during the stage analysis discussion that we had as well. So you need to have some sort of a methodology that tells you what is the supply demand situation for a particular stock or for a particular sector. I mean, it works better at a stock level, and it works very, very well for small and mid cap businesses, not so well for large cap businesses. So basic price volume charts, basic candlesticks. Okay, you don't have to do complicated technical stuff. Just look at this and ask yourself, what is the candle formation telling me? Who's winning this daily battle of tug of war between the buyers and sellers? Do that on a sustainable basis. Track basic shareholding pattern changes for a small cap and a micro cap. You have to just observe one single factor: change in the number of retail investors as the price moves higher. As the price moves higher, something becomes a 3x, 4x, 5x. And if the number of retail investors, let's say, goes up 4 times, 5 times, take it as a signal that this.
Yeah, Kedar, you were telling about take this as a signal, and then we lost you.
Yeah, so just take it as a signal that distribution to retail has already started. If you have a stock price that is going up significantly, right? And if you think this business is not really secular, if you don't have a view in terms of what the future can be, you're just there from a momentum point of view. You should always watch for signals of distribution. The other thing is watch out for echo chambers on social media and investment forums. It's a very, very interesting qualitative sort of an indicator. Just go to Value Picker and track which are the stock stories that tend to see the maximum traction and at what point of time. It's a very, very interesting analysis. And trust me, the community at Value Picker is probably one of the most hardworking, one of the most, I would say, well-informed people who actually do this pretty well. But even there, you'll start seeing certain biases. If I look at my own posts over there, I think there are clear trends that you can sort of look at, right? And finally, start using basic metrics. Basic stuff like relative strength. Start drawing Bollinger Bands. Okay, you have a stock that goes off into a parabolic move. You need to always understand, if you're, let's say, a short-term trader, use the 20-day moving average. If you're, let's say, investing with a 1 year, 2 year horizon, maybe you'd want to stick to a 50-day moving average. Ask yourself, how much is the price far away from this particular thing? So all these are various ways that you can actually use to track the supply demand situation for a particular stock, right? And this feeds into your decision making framework, stops you from making, let's say, a whole bunch of errors at any point of time. So yeah, so just to summarize, understand base rates, use probabilities, ask yourself these basic questions that will help you calibrate. Second point that we covered as part of this segment is you need to have a methodology to track the supply demand situation for a stock. Use behavioral finance, use technicals, use anything else, use qualitative indicators. But this is one base that you definitely need to cover.
So, Kedar, before allowing us speakers Sahir and Subir, one quick question. So, I mean, what the problem of plenty happens when we delve into n number of things at one time, one point in time, and that, I mean, basically that is a hindrance as far as like decision taking is concerned. So, how to work on that front in line with that?
Absolutely. Once again, it's a very, very great question that you asked. So, once again, I'll probably give you an answer that works for me, right? So, every investor has a primary style. So, I'm talking of people who are slightly experienced, who, let's say, see in one cycle, made a bunch of mistakes. So, this answer applies to them. Primarily, some people have a bent of mind that says, I'm going to be a fundamental guy, right? Or some people will say, no, fundamentals is something that's not really up my alley. I'm going to be a technicals guy. Don't deviate from your primary. Whatever other skill sets that you pick up, it has to be a supporting sort of a tool that helps you get better at the primary, right? So if you're a fundamental investor, you do your fundamental work, then you start using the lens of behavioral finance, start using technicals, start using macros, and then you start going through your decisions with a fine-toothed comb, and you start to, optimize and calibrate to the market in that sense. That's a far better way of doing it, rather than to, let's say, go with a disjointed approach. Because everything comes down to this, right? What is your investment horizon? What is your style? I don't like it when people try to do drastic changes in their style. If you're somebody who has, let's say, 5 years, 6 years of experience, if things are going well, you need to learn from other aspects and complement what you're already doing while staying true to your primary style. Don't change your primary from a fundamental to a technical thing. Then what happens is you're using all of these perspectives to improve your odds of getting better at what you're already doing. So does that answer your question, Vince?
Surely does. Surely does. So, Sahir, you can unmute and join in the conversation, please.
Hi, Prince. Hi, Kedar. Hi, Kedar. I had a question. You'd mentioned a reverse DCF and you'd spoken about it a little bit. You were talking about how 20% over the years isn't a very common thing. I just wanted to know what discount rate would you use in today's environment and what terminal multiple would you give, like for like different businesses?
Once again, that's a very, very interesting practitioner's question. And I like the way you frame that question as well. So, what would I do today? So, today, first thing is our estimate for, let's say, the risk free rate is going to be lower for the next 5 years compared to the historical rate. So, we wouldn't probably work with 8%. We may want to work closer to, let's say, 7% in terms of the risk free rate. The second thing is, how do I go about estimating the discount rate for that particular business? Now, if we believe it's a secular free cash flow businesses, then the equity risk premium would probably maybe hygienic, maybe work with a 5% sort of a number, nothing beyond that. Which means for a well-discovered business where liquidity is not an issue, where the business is secular, unit economics are already in place, and where we think the range of outcomes is not going to be very, very high, you will probably work with a discount rate of 11%, 12%. The moment you go to a slightly cyclical businesses where we think the range of outcomes is going to be very, very broad, your discount rate obviously is going to be much higher. You'll probably work with a 13%, 14% sort of a number, right? So that's the answer to question on the discount rate. Now, the problem is this. The problem is, if you now start working at this discount rate, and if you become a Puritan, there will be very few stocks that you can pick in India. Very, very few stocks. You will probably find a handful of names, and for sure that portfolio is not going to outperform the market. So what happens is we look at terminal value this way. We don't see terminal value as an exercise in isolation. We ask ourselves, terminal value is what? You, let's say, take a 5-year or a 10-year horizon based on your investment horizon. You
Lost you.
where I got dropped off. So what I was saying was, terminal value, I think we cannot afford to be very, very bookish in India. So you'll have to ask yourself, is the valuation multiple that the market gives to this business, is it going to change favorably, and for what reasons? Usually the answer is no. In which case you need to assume that the current valuation multiple is probably not going to hold at the end of the 5th year or the 10th year. And then you sort of see what exactly is the sort of numbers that the business can deliver. And eventually it is like this. We need to have a view on that particular sector. If it's a stable sector, it's not going to grow at 15%, 20%. It'll probably do, let's say, a real GDP plus maybe an inflation sort of a number. So you'll have to work with 11%, 12% sort of a growth. So ultimately, I guess this is the way we would go about the entire exercise.
All right. Thank you, Kedar. Thank you, Prince. One quick addition. Like, would you take would you consider taking a median figure as a terminal figure, or is that not appropriate? Like, I agree with everything you said. Like, that made
Mhm.
complete sense. But like, would you think in some cases just taking like a median number, would that work?
So when you say median number, are you talking of
Like,
the median
say a
number?
median, say like a median EV to EBITDA, or a median P of like the last 5-10 years, like last 10 years. Would that work, or would that not?
So once again, I would qualify my answer a little bit over there. So if it's a business or if it's a company which has a fairly long track record, so what I'm saying is, let's say you're doing it for an ITC, mean reversion is going to happen at some point of time. So in that case, the median approach works. But if you're talking of a company that's, let's say, feeding into the entire new energy ecosystem,
Kedar,
yeah. So I was saying, if you have strong reasons to believe, and if this is the outcome of your fundamental analysis, if you believe that the future is going to be drastically different compared to the past, then what tends to happen in the Indian market is this. So once stock discovery starts, you move from a 12, 13 PE, you go to 20, 25 PE, and then you sort of, peak out at a particular level, right? So those minor adjustments you will have to make. So I would say there's no one size fits all approach. We would stick to median and historical multiples if we are talking of, let's say, large cap stocks or stocks that are extremely well discovered, like, let's say, an Astral or a Pidilite or any of those things. But if it's an emerging business, we would definitely have to, make a fair amount of tweaks, and that is where the entire analysis becomes much more qualitative and much more subjective.
Got it. Thank you so much, Kedar. Thank you, Prince.
thanks, Sahir. So, Kedar, we can continue with if any more points are left with, and then we come to the Q&A.
Okay, sure, guys. So I just have maybe two more just points to cover. So I think what we really need to obsess as, say, retail investors, or let's say people who are just about getting into the affluent category, or even if you're a professional investor, is this: obsess over sector allocation and position sizing. Sector allocation, position sizing, and underweighting and overweighting a certain set of factors. So once again, for this, if you do cover all of your bases well, if you understand a fair amount of macro, if you have done the fundamental work for a particular stock, if you understood the competitive cycle pretty well over a period of time, then what ends up happening is you should be able to translate that into a tangible view when it comes to building the portfolio. I mean, you can do a whole bunch of work, but at the end of the
Kedar,
Just recapping. So if you do all of this work, if you cover all of the bases, if you don't have a mechanism to be able to translate that into, let's say, the right allocation pattern or the position sizing, I think this entire thing will become an exercise in futility. So as I said, that middle layer becomes very, very important. So medium term outperformance generally is a function of, are you in the right pockets or not? Right pockets, once again, at the risk of repetition, the same framework. Are the earnings getting better? Is the valuation reasonable? More importantly, is the market reaction to better earnings, is it disproportionate or not? That's it. So that's the pocket of the market where I really want to be. So you need to obsess over sector allocation. We need to obsess over position sizing, because that is what actually moves the needle when it comes to the overall portfolio return. If you listen to conventional GAN, it's mostly about, understanding businesses, but then what do you do out of it, right? So this execution aspect is something that every investor really needs to work on. So you need to have a defined method, and then I would say evolve over a period of time. So to summarize on this particular point, healthy allocation to the right sectors is usually more than half the job done. If you had a healthy allocation into industrials, capital goods, power towards, let's say, the middle of 2022, there is no way you're not beating the market right now. The only question is how much. If you went in with a 25% allocation, you've done a good job. If you were at 50%, this is the point where you need to ask yourself, fine, we've ridden the trend, right? At what point do I start reducing the allocation, and which are the other pockets where we think there are mispriced bets right now? So that's the ongoing calibration that we really need to consider. Final point that we probably want to cover as part of this talk is, see, there are certain times in the market. So once again, I'll have to delve into a little bit of personal experience. There are times when the market is just
Kedar,
yes. Am I back up?
yes.
Yeah, so continuing from there, so there are certain times where you just get stuck in a rut, right? So over there, in a real-time basis, there's a very, very important decision that every investor needs to take. Do you double down on something that is not working? Or do you say, I don't know, maybe there is something that I haven't really figured out yet, right? In that case, so this is what we did in, I would say, mid part of 2022. Whatever we were trying was not working. At one point of time, I remember the portfolio underperformance was almost 7%, 8% benchmark to the BSE 500 over the past 1 year. And it's not a good place to be. So that's when we took a call saying, whatever we are doing is not working. So let's just go out and look at pockets that we've traditionally not looked at. And trust me, that one single qualitative assessment that we did. So that is when we started looking at pockets that have not done well in the market for the past 10 years. Okay, where nobody is even interested even after the earnings basically gets better. So in that case, once you start entering into, let's say, newer pockets where, number one, your understanding is not really great, or let's say your own confidence in your ability is not very high, ideally you start with a higher number of bets, and then you start concentrating on bets where you think the thesis is actually playing out, because your understanding also increases with time. And if you were to start researching a new sector or a new business today, it takes you at least 3-4 quarters of tracking results real time to figure out whether you really have the understanding or not, right? Some of the bets that we took, let's say, towards the end of the last year, today, if you ask me, do I understand that sector really well, I would say probably not. But then we still ended up over there, right? Because we were willing to be brave. We were willing to take our chances because we figured out that things are not actually going well. So to go back to
That's a
repeat. So we were just saying that there are a couple of pivotal points in the Indian market. If you just go back to, let's say, the history starting from 2009, 2010, 2011, what happened was you had the financial crisis. The market rebounded. The market went on to, reclaim its high. Initially, it was the same set of themes that once again started to do very well. But at some point of time in 2010 and 2011, you had to make that read, and you had 2 whole years to make that read. You had to make the read saying, now the incremental throughput that is going to come from the investment side of the economy is not going to be very high. Consumption is where the action is actually shifting. If you had made that bet as a fund manager or as an investor, that tilt away from infra into consumption in 2010, 2011, it was a pivotal moment. Similarly, we believe a similar pivotal moment has already occurred. The tilt away from consumption, the tilt away from a whole bunch of businesses into infra and economy facing pockets in 2022, this was another pivotal moment. It might turn out to be a very pivotal moment. I mean, it's a forward looking statement, but then see, this is the sort of thinking that we really want to do, right? So I guess in terms of the content, this is where we probably want to just maybe sort of wrap up. So to cover the last, just to quickly recap on the last couple of points. So obsess over sector allocation and position sizing. Start off with a method, have a mechanism to translate your observations about what is happening in the market into portfolio actions that you take on a monthly or on a quarterly basis. Otherwise, GAN remains GAN. It doesn't really translate into return. Last point, when things aren't going well, you need to be brave. You need to start taking certain chances, because funneling incremental capital into a set of themes that have done very well for 4 years, 5 years, and are suddenly starting to cool down, it's not really
Right. Kedar?
Any questions?
Yeah, we got Ishmohit along with us. Hi, Ishmohit.
Hi, Kedar sir. Hi, Prince. Hope you're doing well.
Doing well,
All good.
Ishmael. Hope you're good to hear.
So Ishmohit, any questions to Kedar sir, or maybe to supplement the discussion, any counter view or maybe supporting view?
Nahi, though, I had just 2-3 questions. I always enjoy my conversations with Kedar sir. So, sir, just a question is that recently you tweeted on the power of base effect, that one of the businesses has just done a QIP and H2 already the base is like much larger versus the H1 base. So how important, like the investors who are using stage analysis or just doing hardcore technicals and looking for like topping out signs. So how important is to inculcate this fundamental, this fundamental framework of looking at a higher base, which becomes the enemy of the next financial year or the or next 1 or 2 financial year, because companies get into abnormal profitability zones and companies hit
Yeah.
purple patches and then those purple patches start going away. Similar with sectors, is that today we see companies in forgings doing QIPs, companies in cables and wires doing QIPs, 100p IPOs coming, defense companies at 100 and 120 IPO like PE types. So a lot of capital has flown in over there, and if the growth really doesn't come, then there could be stage 3 topping out signs in those sectors. How do you basically calibrate through in a portfolio approach through all this?
Absolutely, Ishmael. So when it comes to, let's say, actions like raising capital, so we try to understand what exactly is the intent of this QIP. I mean, ideally, if I'm an investor in a stock, if the company is not leveraged, I would rather have that company take debt to a particular level rather than going and diluting my existing stake in the company. So QIP generally should be done by.
Sir, lost you again. Kedar sir?
Yes, am I audible now?
Yes, you are. You were telling about the QIP thing.
Yeah, so QIP generally it should be done by company. See, the promoter is signaling something by doing a QIP, right? What exactly is that signal is something that we need to understand, but that's a total qualitative exercise. Now, coming to your other point, Ishmohit, so I believe even if your primary style is, let's say, technicals, it doesn't hurt to sort of look at the earnings trajectory and understand the basic drivers of the earnings. I mean, you may not be able to, let's say, figure out exactly in this particular segment has the margin really topped out, going to the investor calls and all of that, but you need to straight away say, okay, fine, the base seems to be very, very high compared to the historical rate of return. So that way you're able to sort of, recognize certain risk from a fundamental point of view. Along with that, if you start seeing horizontal consolidation after a very steep run, like this particular example that you and I are referring to, then it's a prudent idea to, start evaluating what is it that you want to do about your current holding. So I would put it that way.
Sure, sir. Sure. And so, just my second questions, and others can take the forum. Is that sir? Just looking at a portfolio is like looking at multiple factors. So, positioning for tailwinds is good, and sometimes we also position for some of the sectors where tailwinds might not be there because there might be a pain period in the near term, but the long term tailwinds are extremely evident. So, how do you position the portfolio between the basically strategies? That is, one is कि कहीं पे mean reversion हो सकता है, and कहीं पे अभी business momentum है and reasonable valuations है, so that जो momentum it can keep basically carrying on. So how do you like factor your portfolio approach in these two aspects?
Yeah, so I guess I would call it an ongoing exercise, Mohit. Because see, there are certain pockets now, so that is where risk limit.
Kedar sir.
Hello?
Yeah, you are back.
I'm back. Okay, so that's where risk limits in a portfolio comes very, very handy, because the tendency to load up onto business momentum is usually the highest when the momentum is the strongest, right? From a pure psychological point of view. So right now, I can talk about what we are doing. Certain themes have worked out pretty well, but what really scares us is this: the factor that has generated the bulk, or not the bulk, I would say a significant portion of the returns that we have made. The same factor is starting to now show up in portfolios across all boutique PMSs, right? So every investor in the HNA segment, every investor, let's say the entire PMS AIF segment, everybody seems to be overweight the same set of themes. Incremental money coming into the mutual fund industry is coming more in terms of small and mid cap funds. So these are all, signs that we keep watching, and then we are saying incremental money, we don't want to put it into that sector. Incremental money, we may want to put it into sectors where we believe there are mispriced bets. We are willing to live with a fair amount of volatility over the next 6 months to, say, let's say 6 to 12 months. So we are a proponent saying all these corrections now, I'm better off doing it proactively rather than reactively, because once a break comes in any of these pockets now, you lose 15%, 20% in no time. So that's not the kind of pain that we want to subject our investors to. So we would rather proactively prune a few positions, leave some money on the table, and rotate into sectors where we have a higher level of comfort on the risk that you are taking on the investment. So that would be our philosophy to this, Ishmael.
Right, sir. Right. And sir, sorry, just one last question to add to, because I was listening to the thing, it was very detailed. So just sir, in this time also in consumption sector, even though broadly some of the larger names have underperformed, but there have been sectors within luggage space, basically subsectors within the beverages space, or subsectors within the electronic retail space, or even the jewelry retail space. Whereas had someone done the bottoms up work, those type of bets have really played out. So how to position across, because top down we think that the sector is underperforming, but bottoms up we still find 10, 15 different businesses which are still basically doing 20, 25% types growth and still are at 30, 35, 40 p types. So how to position accordingly?
Yeah, so in fact, this is one of the mistakes that we did in our portfolio as well. We took a secular call on IT saying things are looking very, very dicey, but look at how some of the counters have actually performed. I mean, people who are doing a combination of, let's say, a product and a service. So I guess eventually it's not a smart thing to paint the entire sector with a brush, right? So I would look at it this way: my allocation to a sector is going to be dependent on the outlook for the whole sector. But if I find a bottom up business which I believe is doing really well, I think it's definitely worth a bet, because at the end of the day, we are all bottom up investors, right? We may use sector analysis, we may use stage analysis, we may use a whole combination of factors. But at the end of the day, my unit of decision making is always every stock, right? Every stock, and what is the impact that is going to have on the overall portfolio from a reward and from a risk point of view. So I think it is a very good idea to make exceptions in certain cases. But then the caveat is this: if you want to do that, you need to be very confident in your analysis of that particular sector. I would not do it in a sector that I don't understand really well. I would definitely try to do that in a sector that where I think my understanding is definitely up to the mark. So that's the individual adjustment that every investor needs to make.
Sure, sir. Thank you so much.
Thanks, Ishmael.
Thanks, Ashmoy. So Kedar, we take a very recent example
the order which was published by the government regarding the production of ethanol via sugarcane and sugar syrup, right? So in such situations, I like if somebody is already invested in those companies and somebody who is like looking at the companies after this order, so how one can place their advantage? I mean, what would be your view around it?
So once again, see, the general ground rule we follow is this: any sector where the government can overnight change the rule with a stroke of a pen, and in the process change the fortunes of the companies for the next 3 to 4 years, is a complete no-go for us. It's definitely there in our negative list. So, eh, see, end of the day, what is our objective as an investor? I need to find those 20, 25, or maybe 15 companies which I think will get the job done for me, right? Now, within that, there will always be certain things that we will always miss out on. You can do all the hard work that you want to. I don't think I will ever be in a situation where I can cover everything in the market. So, which is why the thumb rule that we work towards is this: if I can cover, let's say, 75% plus of the pockets in the market, it tells me that my coverage is decent enough. It tells me that my coverage is decent enough. Certain times, what happens is you do the work on a particular sector, but your understanding or your conviction doesn't really change over a period of time. In which case, you will probably take a rational decision as an investor saying, let me focus on pockets that I understand really well, because it allows me to sleep in peace even if something like this were to happen. But yeah, these regulatory actions are very, very scary. I mean, what happened in IEX, what happened in IRCTC 2 years ago, what's currently happening in sugar. If you're an existing investor, I guess that's the risk that you have to mentally reconcile to before you make that investment. Or you say, this is a no-go for me, I'm not doing this for so and so reasons. So I guess you can't really avoid certain things in the portfolio, right?
And you were discussing about the various points, and I've seen people fixated about, say, the business quality aspect or maybe some other factor on basis which they are investing. So, do you think, like, I mean, sticking to only a select few parameters is a good way if that works for them, or it is like for the broader market participant, it is not advisable, even if the quality is not good, there are times you can find opportunities in those pockets.
Yeah, so this is the thing that I've concluded over a period of time. So I would say there is no great incentive for you to be a Puritan. So just as we take a basket approach to portfolio building, we need to keep playing, let's say, 2 to 3 styles at any point of time, right? Otherwise, you run the risk of missing the forest for the trees. So my suggestion would be, I mean, don't get into the business of idealizing one single stock, I mean, one single style of investing or one single investor or fund manager. If you want to idolize, please idolize five. Don't idolize one, right? Take a basket approach wherever possible. Figure out what works for you over a period of time. Once you have enough experience, from there you can sort of do that. So over a period of time, I've kind of figured out that a whole bunch of terms that are taken as investing gospel, huh? We as investors, we don't really have the breadth or the maturity to be able to understand the true significance of that. So for example, circle of competence, it's a very popular term, right? So circle of competence means what? It applies to somebody who's been investing across at least, let's say, a couple of decades, cycles, 3 cycles, 4 cycles. Somebody who says, I understand building materials very well. How much ever hard I try, I am not able to understand pharma well. So let me avoid pharma. I will stick to my circle of competence. It makes sense to somebody of that profile. Whereas if it's somebody who started, let's say, investing recently, I think circle of competence is basically.
Kedar,
Yes. So let me just pick up from there. So I'm saying becoming a Puritan, showing eternal loyalty to one single style after appreciating that styles in terms of their performance is also cyclical, it's definitely not recommended. Take a basket approach, always play 2 to 3 styles. At least it tells you in terms of what is moving in your portfolio, what is not moving in your portfolio. It makes calibration easier. The last thing you want to do is, you don't want to have, let's say, less experience in the market. You read a couple of books written by some star fund manager, and you say, this is the guy, this is the person who I really want to follow. You ignore everything else, and then he goes through a cyclical, let's say, underperformance for 3 years, 4 years. Then see, he has the ability to sit through 3 years, 4 years of underperformance and hold on to his convictions, but you don't, right? So I don't think it's a good idea to be a Puritan. Always keep an open mind. If you have to idolize somebody, idolize 5 investors. Please don't idolize 1 or 2 investors. That would be my sincere suggestion.
Right. So, Babulalji, any question on your side or?
Prince sir, I have just joined, so I was away. I have just joined, so maybe I'll come in later.
Oh, sure. So Kedar, one question which our audience are, I mean, very keen listening to. So broadly, at current point in time, say if you are getting the incremental cash, so if I talk particularly like how you will be placing yourself, would you prefer to keep some cash, or there are pockets or maybe broader areas where you still find opportunities at this point in time, where a debate is ongoing that the small and mid caps obviously have the value don't have the valuation comfort at this point in time.
Yeah. So once again, let me give you a practical answer. What are we doing at this point of time? Incremental money, we are able to identify opportunities that meet our criteria. So for example, last 6 months, what is it that we bought? We bought one auto ancillary company which is trading at 1450 PE. I mean 14, 15 PE, right? Much lower compared to historical valuations. We understand that things may not move immediately, but that's a bet that we are willing to make. We have recently bought into a building materials player where we think earnings is going to come in FY25 and FY26. FY24 is probably going to be an earnings degrowth of 20% YOY, right? So if you are able to find opportunities where you think earnings expansion aayega, okay, where you think valuation is definitely falling within your parameters, we wouldn't want to harbor, bets saying we believe the market is overvalued, we are going to sit on cash. Because eventually when a correction comes, even if the market gets overheated, you will see that not all stocks are treated equally by the market. Some stocks fall 50%, some fall 10%, but they go on to make new highs. So we believe taking cash calls is a very, very brave step. It's an extremely brave step, because when you take a cash call, you are saying, fine, I'm able to time the overall market correction, right? Number two, you're also making another bet saying once the market corrects.
Right. Kedar, you there?
I'm there. Let me just repeat what I said.
Yeah,
So
few seconds.
we're saying, yeah, so we're saying, when you take a cash call, you're saying a couple of things. I mean, you may not do it consciously, but this is the way I look at it. You're saying, I have the ability to call a market top, which is questionable. Number two, you're saying, I'm going to sit on cash. I'm going to wait for the right opportunities to come. Once the correction happens, I'm going to go and buy the exact set of stocks that are going to lead in the next run. Now, the set of stocks that will lead in the next run, the market is going to tell you over a period of time, because please remember that investing is a social science. There is no mechanism that I know is going to tell me which are the stocks that are going to lead in the next run. So cash calls, I think it's something that we have tried in the past. It hasn't really worked for us. Now, if we get to a situation where we believe every single pocket or theme that we're interested in the market is trading at a very, very high valuation, that is the outlier event where we would happily sit on cash. That also we will see what exactly is the yield that we are getting on cash. If we are getting a 4% yield on cash, we may not want to take that bet. But if we are getting a 7.5% yield on cash, the way we are getting right now in a liquid fund, then we'll say, okay, TK, I don't mind doing that, because there is no cash drag that is going to really come and hit me in terms of the portfolio. So it's a very brave call. Let me put it that way, taking a cash call.
Fair point, Kedar. So we got one more speaker, Wall Street. You can unmute and ask your question, please.
Yeah, definitely. Thank you for this opportunity. Hi, Ravi. See, my question is, it's a very broad perspective. Like I'm talking from the Panama Trade and Industry Ministry has ordered Canada's first quantum, to end operations of its copper mine. So, like this, various geopolitics are happening, like Putin going to the Saudis and stuff, on the oil cuts, and the way we are looking at $2 dollarization. what is the impact on the Indian market? The reason I'm asking is, I know US market has gone up, it is skyrocketing, but I feel still it has been manipulated and done by banks here. Whereas Chinese market, if you see previous Friday, I think it was down, totally down. You see, the truth is there in the Japanese 10-year yield treasury bonds, and the Chinese people are dumping the treasury bills of US in past 3 days, and it's all happening. So, what do you project for the Indian market in spot gold? What do you project?
Yeah, so this is where tracking macros gets pretty interesting. So what we believe is this: if it's a really significant event, we have generally noticed that it shows up in currencies and the bond market first. Equity market is probably the last market to sort of react. Now, coming to, let's say, India as a particular thing, I think the prognosis for growth in India is obviously very, very healthy compared to the rest of the world. So that by itself, we believe, sort of places us in a far better manner. Now, the answer obviously would be different for somebody who's sitting outside of India and has the choice of investing into either China or into India, right? Now, most people in India, we don't have that complexity because we either by construct or by choice, we have to focus only on the Indian market. So life for us is very simple. Whereas if you're an asset allocator who's, let's say, managing capital for an endowment fund, and you have a choice saying, do I put money into Japan, do I put money into China, or do I put money into India? It's a very, very difficult thing because you need to have a view on currency, you need to have a view on inflation. So when it comes to any macro development, this is what we ask ourselves: something or the other is always happening at a macro level. Can I take this macro development and synthesize that into a tangible input to the particular sector or to the particular company, which enables me to change my decision? Sometimes you will observe a lot of things, but there is no clear way I can actually tie into that particular business, in which case you'll have to live with that uncertainty. If the answer is yes, we would definitely want to go and sort of act on that. And then once again, this may impact, let's say, certain parts of the economy. It may not impact pharma, it may not impact IT. So understanding the entire value chain, understanding capital flows becomes very, very important. It's a very complicated.
One quick question: what do you think about IPOs? Because recently you have seen IPOs have come down, the market is not up, and people have taken back steps like venture capitalists. What about in India? Is there more IPOs coming, and what are the on that part if you could predict it like that? Thank you.
Kedar, you there, sir?
And there, audible now?
Yes, yes. So
Yeah, so
you
just continue.
you heard the question?
Yeah, I got the question. So
Okay,
see,
go ahead.
if I go through the commentary of all these capital markets listed players who have investment banking wings, their outlook for the rest of FY24 is actually pretty bullish. So which means a lot of issues are going to be coming into the Indian market, right? So I think that's pretty much happening. I mean, QIP is also a form of doing that, right? You can either come to the market for an FPO or for a QIP or for a, let's say, raising fresh capital that comes into the company. But as a fundamental principle, we don't like to participate in IPOs because we believe it's a situation where an informed set of sellers are sort of selling to people who don't have that sort of an understanding. And generally, the IPO issuances tend to pick up pace only after the market has done well. So we see it as a low probability endeavor. We have not really participated in any of the IPOs so far. Not really.
All right. So Ravi, you have any questions? He's busy again. So Kedar, like broadly the points you covered, one point, would you mind repeating again? I mean, take your chances when things aren't going well. So what exactly you were meaning? Can you, I mean, support it with some example that would be helpful because it is coming from one of our audience. Yeah.
Understand. So it is like this. So if I am the average retail or the affluent investor, right? Chances are my coverage of the market is not going to be comprehensive enough, right? There is no way you'll be tracking every single sector, every single subsector, leave alone understanding it. Okay? First step is tracking, second thing is understanding. Generally, what tends to happen, this was my experience as a retail investor. You are focused on your set of tracking companies, which is 50, 60, 75 in number. Suddenly you realize that there's a particular pocket that seems to be doing really, really well, right? So when you come into a situation where the strike rate, see, one of the things that we need to track as a investor is, over the medium term, what is your normal strike rate, right? Some people operate at 50%. Now, coming to my personal experience, my data tells me my strike rate is closer to, let's say, two-third, which means on two-third of the investments that I make, generally what happens is, I mean, if I make, let's say, if I make 10 bets, 6 or 7 bets may we end up beating the FD rate of return. That is how I define success. Those last 3-4 names may generally we end up losing money, we end up underperforming the market. Now I am always tracking the strike rate. If the strike rate suddenly starts becoming 8 or 9 out of 10, I know that I'm having a purple patch, right? Which means I'm completely aligned with how the market is thinking. But once the story stops, chances are I will probably underperform. But once my strike rate, let's say, starts trending towards 2 or 3 out of 10, I know that once again this is an outlier event, which means there is money that is being made in some other part of the market if the market is doing well.
Is it better now?
We can hear you. I can hear you. Yeah.
Yeah, I lost it on my side. I'm not sure. So you can
I mean,
continue.
I even lost it. Yeah.
Yeah. So
So let me just quickly cover what I had said. So I had said, see, always track your strike rate. If your long-term strike rate is 6 out of 10, but in the current market you're operating at 2 or 3 out of 10, it just tells me you're not present in the right pocket. Your skills are still equally good. You're a good investor. Your business analysis skills are absolutely fine. It is just that you're not looking at the right pockets of the market. That's a classical sign that says, okay, let me keep aside what I was doing. Just next 2 months, just pick up 2-3 pockets that I've traditionally not worked on and put all of your efforts into there. Trust me, you'll find 4 or 5 good opportunities there. That's what happens to you as a retail investor.
so Dhaval is one speaker I see. I mean, Ravi, sorry, any questions on your part, and then we go to Dhaval. Unable to see all the speakers, so please manage on my behalf meanwhile.
Yeah, just to say that I've been trying to do something at the back end with the X team. So one tip they've given us is if people can retweet Prince's main tweet where he puts the handle, so if it'll get a boost, or you can quote tweet and retweet. That will really help the space because they're having some glitches, and they're also trying to support, but there is definitely a glitch happening at the X space. So my question really is, Kedar, right now everybody is very bullish about India, right? And we're seeing the kind of the whole global process. We're seeing the impact of the Israel war, the Ukraine war, and we've seen the European market. We're seeing the crisis coming up in Canada, and of course, U.S. market is very much linked to the upcoming elections in 2024, and you'll probably see some relaxations and stuff like that. So in this completely, almost like the space, like the joke we had earlier about the turmoil, where is your, if you had to like really look at the Indian growth for the next, I would say till 2030. I've been doing a lot of work on really bringing especially the Wall Street attention to Indian market. And so I run something called the India 2047, which is the investors forum in New York, which is really bring the attention of all the investors to say that India is beyond just IT. There are many other new sectors, right? Manufacturing, infrastructure, the green growth sector, and of course the AI is almost like the new mega center of AI will be India, right? So where do you see the next till 2030? I won't even go to 2047, but 2030. Your I would say, your strategic roadmap or interest?
So I would probably just make a statement about the global situation first. So this is what we believed for some time now. We see capital cycles in terms of where capital gets allocated across the globe. It also tends to be cyclical, right? So 2011 to 2020 across the world, I believe capital chased a completely different set of businesses, and we were significantly under investing into a whole set of themes, which we believe is probably already starting to reverse in the developed parts of the world. Number one. Now coming specifically to India, a lot of, I would say, factors that prevented non-Indians from considering India as a serious investment destination, I think they are addressed to some extent and are gradually being addressed, right? Both in terms of policy clarity, in terms of how the average guy on the street is looking at his quality of life sort of improving. So there are clear definite changes which I think will catch the attention of the global forum at some point of time, right? So India, in terms of that story, I mean, you look at Indian bond market getting included into, let's say, the global bond indices. We see that as a very, very significant step. It's a very, very huge step. It is something that should have ideally happened a long time ago. So I think there's improvement happening on a whole bunch of things. Once you sort of, get that conviction, say,
We lost you, Kedar. Can you hear us? Kedar?
let me just pick up from where I was, let's say, 10 seconds ago. So we're saying there's a whole lot of things that are happening, but then, as you know, changes tend to happen in a slow manner. So the interesting part is this: there's a whole lot of companies that are contributing to a whole lot of capital coming in through the FDI route, right? But when it comes to, let's say, asset allocators who are mostly focused on the public markets, that is still, I would say, hasn't really come back to the level that it ideally needs to be. So long story short, I think India will definitely become a more consistent and a more reliable market for an investor compared to the previous decade, for due to some of these factors. And that, I believe, is eventually going to reflect in the allocation pattern of some of these large pockets of capital as well. It's just that, the the set of businesses that have done very well in India in the previous decade may not really, lead the next 5 years to 10 years, if that's the horizon that we're really talking of. It'll be a different set of businesses because we've been under investing in so many things, and there's a lot of catch up that we need to do on certain pockets. So I would sort of, put it that way.
Can you just highlight, like, what are we under investing, and what could be the potential? Of course, this is not your advice, but just to just from a discussion point of view.
I think the infra development that is happening in India is absolutely real, right? I think till 5 years ago, if you wanted to fly into a tier 2 or a tier 3 town, you didn't have too many options. And that's leading to a whole bunch of productivity. What the current government is actually doing in terms of infra development, in terms of, doing basic stuff like building railways, infra modernization is a huge theme. So overall productivity, once it kind of really improves. And the other theme which one of the earlier speakers in the call was alluding to, I think India emerging as a manufacturing center, and not just for, let's say, intangibles like IT or stable sectors like pharma or chemicals where we're already there. The kind of commentary that some of the managements are making, they are opening independent entities in the US so that they can actually do serious business there. Look at the sort of traction that we are getting from the GCC countries when it comes to infra development. So as this entire capital cycle really reverses and the capital starts going into more of these brick and mortar industries, I think that's where the real action is going to be in India in the next 10 years. Of course, in terms of valuation, you will always have those cyclical peaks and troughs. Too much will get priced in. People will get disappointed for 2 years, 3 years. But at a business level, I think there's definitely a lot of potential that can materialize in the next 10 years.
Thank you, Kedar. I think we have some questions. And Vikram is
Yeah.
also here. Welcome.
Dhaval and Vikram in that order. Dhaval, you can go first and then we go to Vikram's question. Yeah.
Yeah, thank you. Good evening. So I have a couple of questions, both in synchronized way. One is, how do you see the changes that Indian capital markets are making in current scenario? Like NSE is contemplating few of the changes, like from trading hours to be extended from 6 to 10 or 11. That is one. Secondly, now they are doing, first they moved to weekly expiries in FNO, then now they are going to daily expiry on different segments. NSE, Nifty one day, Bank Nifty, Fin Nifty, Sensex, mid cap, everybody having a different day of expiry. And second, in line with that only, that during the last 6 7 months, where FDI has came into our markets and kept on selling, but the local investment mutual fund companies and everyone has kept our market some on the verges of not just going into a downward spiral. So how do you think that Indian investor per se is, let's say, 10 years before, if FDI came and kept on selling, it would have made mayhem in the market. But now their impact is becoming less and less. So Indian investors' confidence into Indian market in mutual funds and other ways, and entire this slew of changes in terms of the timings and everyday expiry. How do you rate all those changes that is happening in last 1.5 years?
Interesting question. So this is our view. So just go back in time, let's say 5 years, 6 years. You didn't really have too many options in the Indian market, right? I mean, if you went and met a promoter, he was doing, let's say, an investment into one particular mutual fund. Post demonetization, once this entire SIP culture actually took off. So what's happening is, I believe Indian investors are increasingly looking for differentiated investment solutions, right? So this is what we always say. Once this entire capital inflow in a systematic way coming into the Indian market through the domestic route, you rightly said it is going to make our market probably a little less volatile, which has already played out. Number two, there's a whole pocket of investors who will now start looking for differentiated solutions, right? The bigger risk of some of these regulatory changes is this: there is something or the other to look forward to or to do on a daily basis. So if somebody wants to be active, I can be much more active than what I was.
Kedar, lost you.
Yes, guys. So I'm saying there's definitely a lot more things that an investor can do today, can get distracted by. So which is why the next 5 to 10 years, I think if you're an investor in India, you need to be very clear as to what is it that you will do, what is it that you will not do, right? It is something that needs to fit into your scheme of things. You need to ask yourself, where is it that I can sustainably put in effort? Where is it that I cannot put effort? If you're a long only investor who's thinking 5 years, 10 years now, it's very easy to get taken in by this entire F&O trend that is going on. Whereas people will come and post a screenshot saying, I'm making so much of money on a daily basis. So I think focus and the ability to say, this is what I will do, this is what I will not do, becomes very, very important for the average retail and affluent investor. Now, if you're an HNI or a super HNI, what will most likely happen in India is this. Study the history of the US market. 1990s, the hedge fund culture really took off. 15 years, 16 years, people started chasing exotic strategies. Eventually, they realized it's just making, let's say, the fund manager richer. So then the passive investing cult actually started in India. So if you're an HNI, the risk is you will get sucked into a whole bunch of new products which may not really make a material difference to your portfolio. So once again, the key word is focus. Be focused, be clear about what you are doing. Just because you have a lot of choice, it doesn't mean you have to go after them.
So next is Vikram in line. I can't see if he's there. He can surely ask.
Yeah, hi. Am I audible?
Yes.
Yeah, actually, I had one question. It's a hypothesis. I'm happy to hear if it's correct or if it's missing any logical thing. I just noticed one trend about Indian IT companies, this year, where generally there has been some scaling down, but on the other hand, the GCCs or the global capability centers of these MNC, IT and other those who have their back offices as well, non-IT companies, and they are scaling up. I just kind of wanted to understand in the future, is that something that we might see where more of these GCCs kind of have the business. So we will get the economic benefits, but these are not listed Indian companies. They're unlisted or unlikely to be listed in India. So a trend of where we might get the economic benefits, but the capital market benefits may not accrue to us as much as they have in the past 2 decades. It's a pure hypothesis. Happy to hear if I'm wrong or why about this. I hope my question is clear.
Yeah, it's pretty clear, Vikram. So in fact, this takes me back in time almost 17, 18 years. So I was a techie who was working for Infosys at that point of time. So I remember this was the first all hands meeting that I had, where the head of that particular vertical said something very interesting. And this was, mind you, I think this was 2004, 2005, that time frame. So there was a similar sort of a thought process then, because we said Indian companies are moving up the value chain. Infosys became a $1 billion company in 2004. They said if we want to keep growing at this rate, if we want to, let's say, start making a dent, much bigger dent in the entire world, we have to start putting up centers in the US, right? At the same time, the IBMs, the Accentures, and all of these world, they were hiring aggressively in India and they were building their own centers. So it was a question of figuring out actually who's going to do a better job. We establishing presence in the US and increasing the brand visibility over a period of time, or is it a question of, let's say, them coming into India and taking away that entire pricing or labor arbitrage? So eventually how things played out was, I guess, both the themes played out, so it doesn't have to be an either or. So coming to your hypothesis, I think so, but then that also tends to it's not really a secular trend.
Kedar lost.
Yes. So I was just giving the example of an Apple. So if you had spoken to Apple sometime in, let's say, 2010 or 2011, they were like, man, we don't want to manufacture anything in India. You may become a large consumer market for us. So even global MNCs, global guys, they tend to look at things through a different perspective every 10 years, right? Somebody who said we don't want to manufacture anywhere outside of the US, today they are seeing benefits of doing things. So I would say, yeah, hypothesis, it sounds fairly logical on the face of it, at least for the next 2 to 3 years. But 10-year view, I don't know, man. I'm not willing to really harbor, I guess, because see, end of the day, all these operating managers are people, right? Even their judgment tends to change over a period of time. They get swayed by geopolitics, they get swayed by their government policies and all of that. So yeah, I guess always keep our eyes open to the long-term ramifications of any short-term trend.
Thanks.
Hello, Prince. Can I come in?
Yeah, sure. Please. Please go ahead, sir.
Hello.
Yes, please
Yes,
go ahead.
yes, Babel, we can hear you. Go ahead.
Yeah. So my question is, what is the percentage of manufacturing, current share of the manufacturing in our GDP? Is it 13 to 15% or more?
I haven't really seen that number recently, but then yeah, ballpark range, I think that's it's maybe slightly higher than that. Because I remember at one point of time they said you have agriculture, you have services, you have manufacturing. So manufacturing, I think, yeah, ballpark, that seems to be maybe slightly higher than that. I haven't seen the recent.
Yeah, somebody was telling 13. My own reading was 16. Now my question is, if we are not increasing share of manufacturing, don't you think
It is
markets are
sorry, Babel, it's 17%.
what I'm trying to say is,
Hmm?
if we are not able to increase the share of manufacturing in GDP, don't you think that our prices of the current market prices are stretched? Because without manufacturing going up, how will economy do well?
I believe, Babu, there is a very broad ramification of this exact trend that you're talking of, right? Now, even within manufacturing, generally we have a slightly different view on discrete manufacturing and on process manufacturing, right? Process manufacturing, what happens is you need to put up a lot of capex into fixed assets, 300 crore, 400 crore into a process optimization plant. You put up a reactor, you put up something the way a chemical company does. But if you see the number of people who eventually get employed into process manufacturing, it's not a very high number, right? I mean, 250, 300 people are good enough to manage a decent sized chemical plant. But if you get into assembly line manufacturing, which is going to lead to a lot of job creation, I believe that is something which India desperately needs right now, right? Because the high end of consumption, see, end of the day, what is it that you want? Secular basis pay. If I want consumption to go up, I need a broad-based bull run in the employment market, right?
Yeah, I agree with you. Actually, there is capex and MSME and this last sector putting in manufacturing unit vis-a-vis jobs. As per the data, 80% manufacturing jobs are by from the SME sector. Unfortunately, SME sector is not growing the way it should grow because of lot of problems. So, what is your view on SME's growth? And because they are the one who will create the jobs. Am I audible?
Yes, you are. Kedar sir, you there?
I'm there. Am I audible?
Yeah, I can hear
Yes,
you.
yes.
So my
Yeah, I guess
my simple question
I
is
heard your question.
okay.
Yeah, I heard your question, Prabhu. Yeah. So the answer is this. See, if the primary thesis is that India can start assuming a slightly bigger role when it comes to manufacturing for countries other than India, right?
Yeah,
Then entire flow is going to come to the larger companies, because see, a global MNC doesn't really want to take that credit risk of dealing with a smaller counterparty, right? I need reliability in supply chain. So what will happen is the bulk of the export thing is going to happen to the current large size companies. It may not really flow into the SME sector. The SME
that's
sector will have to carve out its own sort of space, but primary thing is they need access to capital.
Right. So, any further follow-up? Ravi, sorry, I'm unable to see the screen, so not sure who is at the speaker and who is at. So, any more
I
questions,
have,
Ravi?
No,
yes, yes,
I think we
I
have
have.
Amit, Wall Street. Amit.
Yeah,
Amit.
go ahead. I'll go ahead, Ravi. So this is a very important question. I heard a lot of people saying. So what is my question is, I'm into digital, and when I'm saying digital, I'm into blockchain and digital currency. So what recently happened in the past week, if you see, I want to take your opinion. Like example, Pay Now Singapore has officially linked up with UPI India for direct connections between these two for real-time payments. Same thing happened with the same with Singapore and China to bring CE/CNY pilots for the same cross-border payments. Now everything is going towards digital in the fintech world. And what I'm talking digital in this is not a digital currency, but a distributed ledger technology, which is happening. Irrespective of what JP Morgan talks and does, difference is there. He talks something, it's a fraudulent, but it does is to behind the scene, he purchases all the asset. Their asset managers are buying a lot of assets from including
Understand?
Bitcoin to other things, right? So what is happening in India is the same thing, right? They tell something, but they do something. People are. I want to understand what exactly rather government tells, rather telling crypto is a fraudulent or whatever it is, but what exactly happening behind the scene between the fund portfolio managers, how they're actually concentrating on digital assets and what is moving through.
So the way the current regulations are structured is this. I mean, if you're a registered fund manager, if you're a registered investment advisor, it is not really seen as a welcome sign by the regulator to actually go around commenting about this digital assets, because this is the regulator perspective. They are saying it's a relatively new trend. It is yet to be tested out at scale. Obviously, blockchain as a technology is something which I remember, I think in 2014 or 2015, some of our leading private sector banks have executed transactions on blockchain. So I think nobody is questioning the veracity of this blockchain technology. But the whole point is, if you try translating blockchain into some sort of a digital asset, which does not really come under the purview of conventional finance, cross-border money can be moved very, very easily without, let's say, the sort of regulatory supervision that you have to the traditional banking channels. That is what tends to make a whole lot of regulators very, very jittery about it. So here's my answer. I think Long term, the regulator is going to wait and watch for all of these technologies to actually stabilize. Okay. And then they will figure out how to use it constructively while protecting the average, the market participant from any of the negative consequences. We believe that is something that will take a fair amount of time, given the fact that RBI has actually been very, very ahead of the curve. Some of the actions that they have taken, they don't really wait for a crisis to happen. They actually come in proactively and sort of nip something in the bud if they believe something like this is happening. But for us as certified market participants to be able to consider that as a serious asset class, I guess there's still a fair amount of time to go, because the regulatory regime currently does not really permit that. At least 5 years. That's my sense.
Thank you, Kedar. I think Prince still is having issues with the screen, but we have two more hands raised. We have Yashwanath. Can you please ask your question? Ishwanath, Ishwanath, are you there?
So Ravi, before that, we'll ask Kedar how good
Are
we
you
are on
able to
time,
hear
Kedar.
me?
Okay, can we have Prince speak and then we come to you? Prince was saying something which I didn't know because he cannot
So,
see the screen. Prince, then we
so
come to
Kedar,
Yashwanath.
we crossed 2.5 hours. So apologies on my part. So I didn't ask about the time. So we are good on time.
I think we are good. I think we can maybe take 2 more questions. That should work.
Okay, great. Thank you. Yeah, go ahead. Whoever is next in line.
Yeah,
Can
Yashwanath. Yes, go ahead.
yeah.
And then we take one more
Am
and
I
then we close
audible?
the space. Yes, you are.
Yeah. I have one question for Kedar.
Yeah, go ahead.
That that the things, the sectors which were working for last decade or 15 years may not be mostly working for next 5 to 10 years, right? Are you seeing any trend regarding this? So you mentioned as a discussion.
Mhm. So I think the point where I was coming from is this. I don't think there is any inherent problem in the underlying businesses, right? It is not a problem saying that the company is not going to grow earnings. It's a problem of valuation, because too much got priced in. There was just too much of groupthink. So this technical unwind of, let's say, the price sort of finding its own feet, and then the market saying, okay, now we see enough benefits in terms of the risk reward ratio, that entire process tends to take a fair amount of time. It takes 2 years, 3 years, maybe even 5 years in certain cases. So to qualify my comments, I think the underlying businesses will continue to do well, but will that be the best performing sector from an investing point of view? Probably not.
Yeah, got it, sir.
Thank you. Let's take the last question now. Here we have wealth creation.
Yeah, thank you for taking my question. Am I audible?
Yes, you are. You can introduce yourself, then ask question to Kedar.
Yeah, so I am a retail investor. I invest on my own. So I'm just trying to understand for next maybe a decade or 5 to 10 years view, India. So which sector do you think can grow faster? Meaning the top 4 or 5 sector, and if you can relate similar kind of with the other countries, example China, when they grow their economy from maybe 4 5 to the double. So if you can correlate a bit and try to relate India story and then see, give some perspective, your thought about which sector can grow faster, example agri, I don't know. So those kind of things, if you can throw some color on this. Thank you.
Understand. So first request would be, please see 10 years as a series of, let's say, 3 years. I think that's the first adjustment that all of us will probably need to make, because 10 years is a pretty long time, right? I mean, if I look at some of the projections that I made 5 years ago, I look like an absolute fool today. But some of the projections that I make for the next year, they have a better possibility of playing out as expected. So look at it this way. So let's reduce this 10 years time frame into a series of 3 years time frame. So then the next question is, next 3 years, what do you think is going to do well, right? So that then becomes a much more easier question to sort of answer. So we believe if policy continuity materializes in the general election of next year, I think the current set of businesses that are doing well will continue to do well. We don't see too many factors that can actually upset the current business momentum, right? The bigger risk is too much get priced in too soon. So chances are the entire expected improvement in the earnings may get priced in the next year itself. That's a bigger risk as a market participant, right? The one of the other things that we're interestingly tracking is once the current dislocation in the consumption pocket actually, let's say, stabilizes, I think consumption will continue to do pretty well. You will have more and more options to sort of invest into various pockets of the economy. For the longest time, you could only pick FMCG, you could pick Page Industries, maybe the odd VIP Industries, or maybe another, maybe a Jubilant Foodworks. But today within QSR, you have 5 names. You come to let's say, consumer discretionary, you have 10 other names. You can buy a Vedant Fashions, you can buy a Metro Shoes, you can buy a premium player, you can buy an economy player. So I think in terms of overall growth, everything will do well in India. Banking will grow. I think lending is going to grow. Asset management is going to go. Insurance is going to grow. Everything will grow in India if you take a 10-year horizon. But the point is, as an investor, where am I seeing more bang for my buck? Are stocks pricing in a 10% growth where the underlying growth can actually be 20%? That's where I want to be, right? That's our primary question as an investor. So yeah, my suggestion would be just try to do this exercise on a 3 years time frame. So I think financialization will do pretty well. Lending in certain pockets will continue to do pretty well. You just need to play the cycle pretty well. Consumption will eventually revive over, let's say, 1 or 2 years. Once the current global situation gets addressed, I think even IT will continue to do well. So that's where the cyclicality of the entire thing comes in, right? So not really a fan of taking a 10-year view. So let's stick to the medium term. That would be my suggestion.
Okay, got it.
Thank you.
Thank you.
Just my suggestion, Ravi. Just my suggestion, Ravi. Here, whatever we are trying to do here, right? It's very important to understand in the current global, the geopolitics, what is happening. Guys, grab as much as possible gold and silver.
Okay,
Buy
sorry,
physical gold and buy
Amit,
physical.
we avoid giving, so let's keep that to yourself. I just want to focus on Kedar. Thank you so much, Amit, for the comment. Um, Kedar, do you want to say some final thoughts before I give it back to the host, Prince? Kedar?
Yeah, sure, Ravi. So first and foremost, I guess apologies for the technology glitches that are happening on Spaces right now. I guess the continuity could have probably been far better if we hadn't had these glitches. But then I'm always happy to, repeat myself to ensure that. So to finally summarize, the whole point is this. So this is something that I had said at the beginning of the talk. So just to reiterate that, the top layer is your investment philosophy and the way you go about investing as a whole. Okay. The bottom layer is where the portfolio actions come into the picture. We are starting to focus a lot more on the middle layer where we are saying whatever is happening in the market within the overall context of your investment philosophy. How do you translate all of these inputs, whatever you are observing, whatever frameworks you have, into actionable decisions that you can take on the portfolio? So that is what the overall, objective of this talk was. So I hope that people were able to take away certain tangible points from this. We should try and implement a bunch of things, and this is an ongoing exercise. It's not that if we do 4-5 things, we would have covered everything. We do those 4-5 things, we get into something else. So I think that's the approach that we need to have. So happy to add value in that particular sense. Over to you.
Kedar, just before I give to Prince, just want to say that, I've done many spaces, but I've never met somebody so patient. You've gone back, repeated yourself, and the way is exactly like the market, right? We need to overcome all the hurdles and keep moving, keep that focus on 3 years, as you just said. I think this has been one of the most, inspiring spaces and from all aspects. And thank you so much. Again, thank you so much, Prince, always inviting us to be part of this. I'd really recommend everybody to follow Kedar, the host. Prince is a great person to follow, to know all the amazing speakers he brings. And hopefully, I'll get to meet him in person in 2 weeks in India when I'll be finally there. So back to you, host Prince.
Thanks, Ravi, and look forward to that. And Kedar sir, I must say, like you justified the today's topic of discussion by sincerely bearing the glitches in Twitter. But nevertheless, it was a great, insightful session. And to summarize on my part, so broadly, sir covered that what had worked in the past may or may not work in future. So we should not be sticking about that. And even there is an element of cyclicality when it comes to investing. Yeah.
And as far as like attribution analysis is concerned, so you need to be very conscious like where you are overweight or underweight on. So rather than I mean, you should be focusing more on like how you can improvise day by day. And obviously there is a cyclicality element in alpha generation as well. And there are two possibilities when it comes to that market has its own mind. So either the we go to the market view, or the market comes to our view. In both the cases, we end up making good money. And obviously like for many, I mean, how we can work on these. So basically broadly he covered 7 8 points, which covers minimizing your spots, and be aware of the factors that have worked well in last 2 years. And you should also be knowing what has not worked in last 2 years, so that you can thoroughly analyze how the broadly market is behaving. And as he was saying, like it takes a lot of hard work, but again, if the homework is done right, then definitely it will be a basically it will help you big time in your investing journey as an we progress. So understanding the macros is one thing, knowing the history, understanding the base rate. So these are all things one should be like conscious of, and understanding there has to be some methodology so as to track the supply and demand situation for the stocks. And we should not be fixated about one thing, we should be flexible enough so as to like improvise our framework. And the last point about the obsession about sector allocation and position sizing. So these are wonderful aspects which are covered by Kedar sir, and we sincerely thank him speaking for almost 2.5 hours, that too with great points and citing great examples so as to make us understand in an easy manner. Thank you so much, sir. And I would sincerely encourage our audience to listen to the previous conversations, the one with using the operating manager's experience, and understanding the stock cycle. So very soon, although it will take some time because there were some intermittent glitches, I'll upload this conversation as well, and surely you can listen to all these conversation. And there would be a lot of takeaways for all of you, be it for beginners or seasoned market practitioners as well. Thank you so much, sir.
Thank you, Prince. Can I just recommend everybody follow Prince's YouTube channel too, and please follow our lead speaker today, Kedar. Everybody, and the host. Can everybody give a big round of maybe a heart or a round of applause to our speaker? Thank you so much again, Kedar. I don't know if you have final thoughts, and we'll let Prince end the space.
Yeah, sure. Thank you, guys. So, always happy to add value to others, because this kind of discourse that we are having in the Indian markets today on platforms like this, I believe this is a very, very integral part. Otherwise, what happens is the newer generation of investors, they will probably end up making the same set of mistakes which the previous generation also made. So, I think that is how the entire ecosystem actually grows. So, very happy to be part of this. So, it's been a great experience interacting with all of you. So, hope to do more of this in the future as well.
Surely look forward to that, sir. Thank you so much. And thanks, Ravi, for being so kind and joining us on short notice. And your sessions are wonderful as well. And surely people would love to connect with your handle as well. And definitely, we as a country and we as an individual should be doing great with such sort of platforms, providing us the opportunity so as to create a virtuous circle wherein everybody is benefiting. And we are in our limited capacity doing our social responsibility. So with that note, I thank Kedar sir once again, and definitely request people to connect with his handle so that you can have access to the different perspectives which are very relevant to the market over his handle, and surely you will find value addition over there. Thanks, everyone.
Thank you, everybody. Thank you, Kedarji, and thank you, Prince. Thank you, everyone.
Thank you, everyone. Bye.